Right. Good afternoon again, everybody, and welcome to Beach Fundraising, our finance symposium for this semester for spring 2023. I will let our dean, Dr. Michael Solt, kick the symposium off with a few words. Thank you, Dean Solt, for being here, and the floor is yours.
Well, thank you, Dr. Gupta. I'm really pleased to be able to welcome everyone to the 6th Finance Symposium, Beach Fundraising. Each one has been an excellent discussion with presentations by a range of professionals in the finance world, providing interesting and informative talks and providing an opportunity for our students to learn and ask questions. And I have been really pleased with the questions that our students have been asking. This is a wonderful afternoon, because it does bring together students who are learning about finance with professionals who have a lot of experience. We oftentimes think about universities, the center of the university being the classroom where faculty and students come together to learn. But the Beach Symposium has proven to be another venue, another way of informing, educating, and learning. So I welcome each and every one of you to this event. I know we have some great speakers lined up. I look forward to hearing and learning myself. So let's have a wonderful afternoon. And again, thank you for inviting me, Dr. Gupta.
Thank you, Dean Solt. And as Dean Solt mentioned, over the past 6 symposiums, we've had experts come and speak on various topics, from cryptocurrencies to investing to personal finance, etc. And this time we decided to focus on real estate because, as we have all seen, the effect of COVID on and how it basically affected commercial and residential real estate differently. So we are focusing on real estate, and we have experts in all these areas, including someone who is going to talk about careers in real estate for our students. That will be very helpful for our students. So, without taking much time, I would just like to thank a few people here without whom this wouldn't be possible. Something like this takes a lot of work to put together, and there are a lot of people working behind the scenes. So starting with Dean Solt and the Dean's office, without their support, this wouldn't be possible. So thank you, Dean Solt, for making this happen. I'd like to thank my department for always helping me and supporting me in my endeavors. I would like to thank Ella Gomez, our development coordinator, for making us connect with some of our speakers. I'd like to thank Madeline McJones, our webmaster, for helping us design the website for Beach Fundraising. Also, Nupur Shah, our computers center director, for helping us with all the technology and for just being there whenever we need him. Various communications people throughout the college have helped us promote the symposium, sent out a bunch of emails to different community colleges, schools, high schools, other Cal States, and promote on social media. So I'd like to thank all of them. I'd like to thank my student assistant, Jaslyn Simon, for helping with the flyers and for helping us promote. And there are 2 very, very special people but without whom absolutely this wouldn't be possible. That is our full-time lecturer, Frank McAnulty, who started this with us from the very beginning, whose contacts have helped us enormously. And really, without him, this would be impossible. And very lastly, the most important person is our department coordinator, Ms. Kelly DeSimas, who basically took care of pretty much everything without even having to give her directions. She had her finger in just everything. And so Kelly, thank you so much. We could not have done this without your help. So with that, we have our first speaker, Brad Christensen, and Frank will introduce Brad.
Yes, first speaker is Brad Christensen. He's the managing partner of Pathfinder Mortgage Corporation, and Brad's been working for over 35 years in the mortgage business. commercial real estate financing for specific income property types, and with specialty in acquiring very low fixed rate interest rate loans. He's great at originating loans and is the managing partner of Pathfinder's operations and its Orange County branch. And excited about having Brad here today because a lot of people don't think of, careers, the mortgage business, it's sort of like, it's a brokerage business, people think of it, but happy to have Brad tell us how it's far beyond that. You're just not a middle person. There's a lot of financial analysis and work that goes into it. So Brad, it's all yours. Thank you.
Okay, well, thank you, Frank, for that. Can you guys hear me okay?
Yes.
Okay.
I'm sorry, Brad, just 1 second. I just want to mention a housekeeping rule. I'm so sorry. If you have any questions, please just text them directly to either Frank or me. Please do not unmute yourselves. Yeah, please put them in the chat. Please put your questions directly in the chat to Frank or me. Thank you. Brad, please continue.
Okay, great. So let me see if I could share my screen here. And hopefully it'll come out okay. Okay, can you guys see that?
Yes.
Yes.
Okay. Okay, so I was chatting with Frank and he thought that maybe a good question that I could talk about would be what are the career opportunities in the commercial real estate finance industry? And as he said, that's an industry I've been in for, almost a little under 40 years now. Came into this industry, into this position, into this company, right out of when I was in your guys' position, right out of college. And have been in it ever since. So I think I'm a good person to talk about, the longevity that you can have in this business. So I thought a way to do it would be, in my mind, how do I break down the industry into the various types of careers? Okay, so I broke the industry down into 3 types of categories. Capital providers. So these are the banks and the guys that actually provide the money to the owners of commercial real estate projects. And then there's the mortgage bankers and the mortgage brokers, which are sort of the deal guys that kind of put the deals together. Maybe if you were to think of this as like a football team, you might think of the capital providers as the running backs and the wide receivers, the guys that actually carry the ball over the goal line into the end zone. But the mortgage bankers and the mortgage brokers are sort of the generalists. They're trying to figure out who should get the ball. And the mortgage bankers and the mortgage brokers are the guys that they have to know a little bit about everybody else's job, and everybody else has to be an absolute expert in their job. So think of it that way. And then there's the industry, you could call them industry vendors or the support industry. These are the people that provide due diligence services. Think of attorneys that provide legal services, escrow, insurance, those types of roles. So if I was coming out of college and I was thinking, where might I want to fit into these different types of categories of occupations? One thing I might look at is where do I want to place on the money curve? So I created this graphic. And what it is, it's kind of the landscape of all of these kind of half a dozen different types of capital that are out there. And each has their own corporate culture, their own deal-making characteristics. They fit in different places within the market. And so, like I would take this, my client my client is the guy that owns that anchored shopping center with a grocery store and a drugstore in it and a bunch of satellite tenants. And maybe he's looking for a $25 million mortgage on the property. If it's owned by a family, they may want to put a really long-term fixed interest rate on that property. Well, if that's the case, you could look at this graph and you could say, well, if I wanted a 5 to 10-year fixed rate, I could look at the banks and the Wall Street types and the insurance companies as all competitors for my business. But if I wanted a 20-year fixed interest rate, well, then I've got to go to the only player in town, which is the insurance company lender set, because they're the only guys that'll fix a rate for 20 years in the industry. Or maybe I'm developing that shopping center. Right now, it's just a vacant piece of dirt and I'm a real estate developer and I want to put that together. Well, it's a higher risk investment opportunity at that point in time, because right now it's just a piece of dirt. So maybe I want to go to more flexible, more exotic types of financing dollars. And so that's going to be somebody like private debt capital, or it'll be actually institutional equity partners. And one thing I should emphasize here is this is entirely the institutional lender set. This does not include a rich guy that is maybe making private first trust deeds or second trust deed type of investments for his own account. These are the guys that are all institutions that are out there looking to kind of place their money into commercial real estate. Here's an example. Let's say we're going to develop that shopping center. And maybe it's a $10 million total cost project. Then maybe one thing we might do is we say, okay, we're going to create a capital stack. We're going to stack all the different types of capital we got. And somebody looking for an occupation might say, well, where do I want to fit in that capital stack? So maybe the developer is going to get, maybe he wants to be this portion in the yellow right here. Okay, that's the senior debt. Think of that as like a first trustee type of mortgage. They have the first claim on that asset if things go south. And then we'll put on some more exotic debt, mezzanine debt or sub debt on top of that. And it'll pay a higher interest rate, maybe something like 8 to 12%, but it's flexible and it's willing to take more risk. And then maybe the developer, he's going to be at the top here where it says sponsor or developer, and he's going to put in a little bit of the equity, the down payment, if you'll kind of equate it to that. But he needs a partner that has a big financial statement to be his partner and put in bigger amounts of money. And so that's the joint venture equity partner. Some institution will do that role and they're going to get paid, more, and they're going to take more risk. Another type of example would be the opposite extreme. Let's say that shopping center is already built. It's already up and ready to go. And it's been there for 20 years. Well, that's a low risk situation. We can go back and we can look at the historical financials and see how it's performed over time. So we can take a much simpler, lower cost type of financing. So that family that owns that asset, that same $10 million asset, maybe they'll put in a larger amount of equity here in the red, and the senior debt will still be about the same, but you don't need to pay those higher rates of yield for exotic debt because the risk on the transaction is lower. So the different players will fit into different types of situations. The guys that develop new projects are a very different set of capital providers than the guys that do existing structures that are around and, are stabilized. So I think I'd start first with maybe the most conservative, but lowest cost type of capital provider. And these are insurance companies and pension funds. A lot of people don't know that insurance companies and pension funds are really one of the largest holders of commercial real estate debt in the country. And the reason for that is because they need very safe long-term investments to match up against their liabilities. So if I buy an insurance policy from Travelers Insurance, and maybe I'm buying a 10 or a 20-year term policy. Well, they need 10 or 20-year investments to match up against that. And commercial real estate is really good for them because not only do the owners of those projects are they're looking for fixed interest rates for that long, but they're also looking for that hard collateral behind the loan. So it's not an unsecured loan. They've got that hard collateral there. And the insurance companies, they've got to be there in 20 years to pay off on those policies. So their market position, I thought, is they're going to be senior debt products. They're looking for the safest position in placing these loans. And that might be something like a 50 to 55% of the property's value. So think there's a lot of equity above them. The owners of the real estate are not leveraging very high. And today, those interest rates for a very common product, which is a 10-year fixed rate, maybe amortized over 25 or 30 years, so it's a balloon payment structure, but that interest rate might be about 6%. Insurance companies and pension funds are naturally, where do they aggregate their money from? They get their money from premiums on insurance policies and 401k retirement funds, those types of assets. Their corporate culture is very conservative. A lot of them tend to be located in places like Iowa or in the Midwest, not always, but around. But the reason for that is it's just a very conservative type corporate culture. A lot of people go to work for these insurance companies and they just stay there and they progress up through the ranks. So a lot of people may go to work, they may only have 0 to 2 career changes as they kind of run their careers through the real estate lending departments of these insurance companies. The education required would be a bachelor's degree. And then as you're into the institution, a lot of these investment officers will start pursuing their MBA or they'll start pursuing some designations. And some of those designations are the Chartered Realty Investor designation. The Chartered Financial Analyst is sort of a very well-known designation. Another one is member of the Appraisal Institute. And then the common career track is they come in as an analyst. Pretty much everybody kind of comes in as an analyst, which means you're collecting the financial data from the landlord or the developer on the property, and you're building it into Excel spreadsheets and really getting to know the numbers. The contracts are coming in. The analyst is organizing them, reading them, doing reviews and summaries of what the lease contracts might say, getting the package, kind of building a file that's going to go before an investment committee. And then the portfolio managers will take that file and they'll actually be presenting it and conducting the negotiations. So the next category would be banks and credit unions, big lenders on commercial real estate. They tend to also want to be in the senior debt products, but they price a little higher than the insurance companies do, and they do it for a shorter period of fixed rate time. So they're in a little bit different space with some crossover, and they're a little more aggressive in their financing. So yeah, they get a little higher interest rate, but they also are a little more aggressive in what they're willing to do. Their source of funds is going to be our bank deposits. And their corporate culture, I think, is also conservative, but not as conservative as an insurance company. And a lot of people in the real estate lending side of the banking industry might have 3 or 4 career changes through different banks. And the reason for that is because the commercial real estate lending role is a specialized role within the banking community, at least it tends to be. And for that reason, to progress up through the ranks, they get recruited. So you're at one bank and then another bank recruits you away for more money, to another bank. And that's kind of how they kind of work their way through the career. A bachelor's degree is required entry level. And an MBA is not necessary, but it's also very helpful, particularly as you're trying to progress through ranks. In a career track, again, everybody starts out as an analyst or junior banker, and then they'll move into a loan officer position or a relationship manager position. A loan officer position might be very specific to just real estate lending. A real estate manager position is a broader position. Real estate lending would be part of it, but they would also have a mastery of lines of credit, revolving lines for inventory, other types of financing products beyond just the real estate scope. Another way people might go would be, hey, maybe they want to be not on the business development side, bringing the customers into the bank, but instead they want to be on the decision-making side for these financing loans. And so that's what I would call a credit underwriter. Think of that as there's not much deal-making negotiation there, but there's a lot of analysis, a lot of hard brain work that goes into it. And then if we moved into the next category, this would be Wall Street investment banks. And when I first started out in the 1980s, the Wall Street investment banks were not present really in the commercial real estate finance industry. But then the 1990s came along, and in Wall Street invented a product called commercial mortgage-backed securities. And it's a senior debt product. And it comes at a higher rate of interest, but it's, it can get a lot more aggressive, but it really found a home in our industry here. And so it tends to be primarily 10-year fixed rate loans amortized over like 30 years. But it's a big force in the marketplace. It started from nothing in the 1990s, and now it might be, a third to 40% of all the commercial real estate debt that's out there. And the way they aggregate their money to lend is they go to the same insurance companies and pension funds we talked before, these guys that are kind of insatiable in the, needs that they have for long-term fixed rate investments. And they just use their money as well, and they put it out in their format. It's an investment banking type of culture. So it's very aggressive, very fast moving. People move around a lot. You might have 3 or 4 career changes, move into different institutions. The quality of people tends to be very high, but it's also an industry that's very cyclical and volatile. So you can have a year where you're just killing it, and then you have a year where you got laid off and now you're looking for your next gig. But that's Wall Street, right? It's a bachelor's degree is where you want to start, and you'll start out as an analyst. The analyst roles are very intense. And then a master's degree is not necessary, but it, may be helpful to kind of move up the ranks. Kind of depends on where you're going. So the career track would be start out as an analyst and then move into a relationship manager position, or move into that credit underwriter type of position. And then you might change employers to kind of make more money and advance to higher levels. Private debt funds. So think of this as the commercial real estate industry's version of hedge funds. Okay, so they're going to aggregate money from wealthy families, all kinds of other sources, but these are guys that are looking to get higher rates of yield. So they need to take more risk. So it's that kind of environment. It's a very highly analytical type of environment, very entrepreneurial, fast moving. Maybe they're doing not just senior debt products, but they're also doing subordinate debt products. And a subordinate debt product would be analogous to your second trust deed or third trust deed type of mortgage. They do it in a mezzanine format, which is not exactly a second or third trust deed. It's a little different security interest. But it'll get rates of interest of 8 to 12% currently. It's shorter in duration, so you work hard to put the loans on the books. You get paid a lot for a few years, and then they pay off. And it takes the capital stack to higher levels of leverage. So this is used very often on a lot of newer real estate development, I would say. So building that shopping center from scratch gets used on this a lot. Because it's so highly entrepreneurial, your bachelor's degree is critical. Probably nothing needed beyond that, as long as you're a performer. That's really kind of what the industry values. It really values, talent. And the common career track is one would start as an analyst and then kind of progress up the ranks to either a relationship manager, which is sort of a business development role, or to a credit underwriter, which is kind of staying in the analysis but decision-making position of making those loans. And then these same kinds of institutions also invest as equity partners with the landlord or the developer. So it's really the same kind of companies that kind of do two things. They'll either put money into your project as a debt product, or they'll put money into your project as just equity dollars and share in the upside ownership benefit. So equity returns on commercial real estate tend to kind of be in the 20% and up type of range to get a project off the ground, from a development standpoint. So they'll share in that. And they're collecting their money from wealthy families, hedge funds, but they'll also get it from insurance. Insurance companies play in this game a little bit, and so do pension funds. Same cultural characteristics of the companies, and education is about the same. I would say that there's two kinds of career tracks that start to kind of come in now, and there's start as an analyst and move into production, or come from a different industry, come from a different side of the industry to get into it. So a lot of people get, a decade or more experience in another industry and then bring that over to the private equity funds.
Brad?
Go ahead. Oh, and then I would say there's a specialty lender category, which only is in the multifamily apartment space. And that's Fannie Mae and Freddie Mac. So we've all heard of them on the residential side. But they're kind of they have like a big part of the industry that's just focused on them. Their money comes from the sale of bonds. Those bonds get enhanced by the implied government guarantee. A lot of those people move into that industry, and they never do anything other than apartments and multifamily around the country. And you'd start as an analyst, and there's kind of a very linear, well thought out career path in that industry, kind of doing just the apartments. That's a critical, if you think of housing, that's a very critical part of the commercial real finance industry. It gets special attention, it gets better pricing than everything else.
Okay, Brad, I do have a question from a student.
Sure.
And they were asking, what prior experience or knowledge did you have before your first job in commercial real estate?
Oh, well, for me, I had worked my way through college as a carpenter. And I thought that my career path was going to be as a real estate developer. So I felt that I knew the construction side through my hands-on experience as a carpenter. So when I got out of college, I thought I needed to learn the money side. And I went to work for this company, Pathfinder, right out of college, and found that I really liked the money side. And I didn't need to take all the risk of being a real estate developer. I could just go find the money for the real estate developers. And so that's how I got into the role. So you don't really need experience to get into that from an analyst position, but you will need experience if you want to move either up to higher levels or jump to different companies, or of that graph, kind of different parts of that graph. That's where you need the experience. And experience is very, very highly valued in this industry. Because if you think about it, you're making big bets, multi-million-dollar bets. And, so somebody that's got a good track record they can show of having made wise, prudent bets goes a long way for making a career.
Thank you.
And then you kind of get into my role, which is the mortgage banker, the mortgage broker. So
Sorry.
you can come into this role like I did as an analyst, and you do that for about 3 years. And then you'll move into the deal-making role. Or you can come into the industry having done a decade of experience someplace else, perhaps, or more. So we get a lot of guys often that have done 20 years or 25 years in the banking side of the business doing commercial real estate financing. And then they want to move into this side of the business and use that Rolodex of contacts that they've developed over the years. And so it's a very entrepreneurial, it's a conservative business. One of the things we just had, my industry has its big annual conference in the middle of February every year. And one of the things I noticed when I started going to that conference, decades ago, when I was young, was how much gray hair there was in every room. I mean, this is an industry that people can come into and they can make a career out of, because everybody at the conference, has got a complete spectrum of ages. And it's an industry that really values judgment and wisdom. And so you got a lot of gray hair in the room. And so it's a place that one can really grow. And there's a few, you really only need a bachelor's degree to be in my business. A master's degree would be helpful, but I think even more helpful are some industry designations. So these are kind of specialty to the commercial real estate industry. One is Chartered Realty Investor. Another is that member of the Appraisal Institute. And then CCIM, which is Certified Commercial Investment Member. These are all things that you can pursue as additional education after you've kind of landed the job. And then lastly, I'd come to the industry support vendors. And I sort of broke this down into into 4 categories, but one is all the providers of due diligence. So if you think about it, I'm coming from the perspective of evaluating a project to invest in. And so you have all these due diligence requirements. You want to make sure you don't make a bad decision. So you've got to hire an appraiser to make sure that you're not overvaluing the property and lending too much money on it. You want to hire environmental engineers to create research on the property to make sure that, there isn't some sort of toxic contamination issue with the soil. Now we're required to clean it up. You want to make sure that the building improvements are sound. So you'll hire construction engineers to create property condition reports. And then there's civil engineers. You want to make sure that you understand your property lines and that you're not encroaching onto somebody else's property and they're going to sue you because of that. And so that goes on and on. So these types of due diligence providers, they're predominantly done on an outsourced basis, and they're highly specialized type of roles. Of course, legal, there's the attorneys, right? The attorneys got to have them to draft the documents and mediate disputes. Title insurance is very key because that's the guarantee that the lien positions that our lenders are receiving for the money they're investing into those properties are sound and, they're backed up with guarantees. And then escrow, which is really, in our industry, it's an independent, trusted third party that kind of is the clearinghouse for all the funds. So when a capital provider wants to give money to a real estate developer to invest in his project, he didn't just wire the money to the landlord. No, it goes through a trusted, independent third party that's going to kind of make sure, according to some written instructions, that everything happens legally, gets recorded, money exchanges hands at the right time and such. So that's kind of what I got. Another, I think another resource that I would recommend to you is my industry has a very well-developed association, trade association called the Mortgage Bankers Association. And they provide huge amounts of research, and they have all kinds of career path type opportunities that they provide. They provide education. So I would go visit the Mortgage Bankers Association of America website, and you can really just lose yourself for days in all the offerings that they have. And then I had one other thing that I thought might be of value to you. And that is because I recently came 2 weeks ago from my big industry conference, I got a list of the attendees, and I made that available to Frank. And so anyway, these are all those different capital providers, mortgage banking companies like mine, as well as the third-party vendors that provide the due diligence services and such, and some people that you could reach out to and if you wanted to kind of explore what's happening. So anyway, I'll open it up to questions if there are any.
Well, we'll give
Question.
the students a chance to type them into the computer. You know, I've been involved in real estate most of my career. You know, almost everything you talked about, I've had to deal with somewhere along the way. And I think the important thing is that people need to realize is how many different potential aspects of the industry they have available to them once they get into it.
Yeah, it's a big industry. It really is. With a lot of areas that people can partake in. I would say that, you know, one thing you might think about is your own personality type and how that might match up with some of the different roles. So if someone is very much into, they want to be on the deal making side, they want to be on the negotiation front end. Okay, a lot of tension, a lot of stress, right? But the opportunity to make a lot of money and to do some big things. Other people might say, you know, they want to be, they're just really interested in the analytical side, the intellectual stimulation that comes from just kind of figuring out how you're going to skin the financing on a particular project, giving all kinds of hurdles and such. And that might go into the credit underwriting type of role. So really you can pay a lot of, I mean, there's a lot of places that one can go to, but look at that. Look at, you know, where you think your interests and your personality might fit best.
Okay, so the question came in, are the qualifications for selling commercial and residential more or less the same?
You know, they're not. And this was an interesting thing. Forever in my career, the only our only regulatory industry was the Department of Real Estate. And so for me, it's the Department of Real Estate in California. And then the great financial recession came along and Dodd-Frank Act came into play. And that really changed the residential side of the business. Now they've got specific licensing and training that they have to go through to do home mortgage financing and 1 to 4 unit type of financing. But I don't know who the lobbyists were on the commercial real estate side, but they were really good because what they did was they were able to, the commercial real estate guys were just left alone. They were, so the licensing is still the same. I've got to have a commercial real estate license. I'm going to have a real estate license in the state of California. But that is my only regulatory oversight industry. And that has not changed even after the Dodd-Frank Act. But I will say that the training is really just on the private education side. It's going to, one of the things I did early on was I went through the curriculum of the Appraisal Institute. And I found that was really valuable because one, everything comes back to what is the value of an asset. And being able to really understand the ins and outs of that gave me the ability to negotiate and really argue intelligently on issues of value.
The new question, what types of undergraduate courses would you recommend a student take for a career in your industry?
You know, that's a good question. That's one I think back from time to time about the courses that I took in college that I used the most. And I can tell you, I've got some strong opinions about that, but I think obviously your accounting courses are really important. And then once you've got the accounting courses down, then the finance courses, because the finance courses are, in my mind, how do you take the accounting and start to manipulate it so it makes sense from a finance standpoint? And then the third area I would focus a lot on is take a lot of business law classes because contract law is something that you never stop. You never stop using in this business.
Okay, the next question is the main difference in the skills needed between a residential mortgage lender and a commercial mortgage lender.
You know, I think when I talk with residential mortgage lenders, and I do a lot of business collaboration with them because very often they're financing somebody's home and that person has a ownership interest in a piece of commercial real estate. What I find, and I haven't done that side of the business, but what I find is that it's a very highly regulated part of the industry. So it's kind of like being a tax accountant. You have your theory, but tax law has all kinds of exceptions and all kinds of, so you need to have a mind, I think, that can wrap their head around a lot of data. So now my side of the business is, I would say, more theoretical. It's more does the piece of real estate and its market make sense? Am I building an office building where a shopping center or an industrial property should be, right? So it's more theoretical in that sense. So maybe I'm arguing and thinking of issues of, does this make sense in the market? Whereas a residential person is thinking, how do I weave my way through all of the regulations and exceptions that have to create value for my client? I think the residential people, that's the way I'd put it. I think they have to have a lot of facts at their command all the time, where in my field, it's more about arguing and negotiating on theory.
The next question is, how can I prepare myself, or what skills do I need for analyst positions in real estate, commercial real estate?
Well, it would be those three areas of classes that I talked about. And then I would say very strong Excel skills, Excel programming, because we do a lot of spreadsheet work, And I think if you've got that down, you're pretty much, in a position to apply for an analyst position from any of these types of capital roles. And the industry needs people. When I go to the conference, they need people. They're hungry for talent.
And the next question is, and you can decide how you wish to answer this. They're asking if you have your own real estate investments besides what you do for your job, besides your house.
I would say this. my real estate investments tend to be through the public real estate investment trust markets. So I've made most of my real estate and commercial real estate investments through my Schwab account, right? Buying REIT stock. And there's a reason for that. One thing about the commercial real estate industry, and from my role as a mortgage banker, is it's a very volatile industry. So we'll have years where we do really well and we're making good money. But if we've got money at that time and we want to take excess funds and invest in commercial real estate, prices are high because that's why we made so much money, right? Because we're catching the curve up. But when the curve is coming down, when prices are getting much more reasonable, our income levels are suffering. So I've found that mismatch between when the opportunity happens and when we have cash to invest doesn't match up very well. So that's why I've kind of made my investments through the Schwab markets when I can. Now that said, if you're in the industry long enough and you develop some very close client relationships, clients will sometimes invite us in. They'll say, hey, we're going to pay you a fee of perhaps 1% of the amount of capital you're going to raise for us. How about you throw that fee into an equity position in this deal? And that has happened from time to time. But you really have to be careful with that because you're a 1% or less partner. And if you're not in perfect alignment with the ownership team on the development, it doesn't work out real well. At least I don't think, unless you're with the right people, right? If you're a bigger investment, you have more say. If things get tough, you can kind of get involved in working it out. But if you're a 1% guy, you're kind of along for the ride. So.
Yes, it can be very tough being the very minority partner.
Yeah. Yeah. And a lot of times they don't want 1% partners, right? They don't want to aggregate 100 guys to create all the different equity. They just want a few partners. So very often the owners don't want 1% partners either.
Okay, right. A very specific question. Do you use Argus software?
I have, and that is kind of that's one of the big corporate type softwares that is used really heavily on the ownership side. So, and it's also used by some of the lenders who want to receive their analysis. But if you think about Argus is really a super high-end, well-developed Excel spreadsheet type of stuff. So I think in Argus plays well when you're dealing with certain property types. So if I'm doing a 22-story office building, Argus is critical. But if I'm doing an apartment property with a similar number or more tenants, maybe it's not so useful because those leases are shorter term. It reacts to the market more frequently. So we will use Argus when we need to use Argus, but it's not applicable to every property type very well. And it tends to be mostly applicable, I think, in my mind, to properties that are multi-tenant with staggered lease terms way out in the future, because it's got the ability to calculate the various valuations of those staggered lease terms. But if you're dealing with a single tenant property, you can do that without Argus. If you're dealing with apartment property, well, your tenants are turning over so frequently that this future valuation is really based more on, whether you think the market's going up or market's going down.
Okay. Will internship competition in your industry be as intense as it is in Wall Street investment banks?
I don't think so. I think if you're going after the institutional type of internship, they're hungry for people, is what they want. And there's not enough people. When I go to my conferences, there's too much gray hair in the room. Right. When I was coming out of college, commercial real estate was a hot ticket and a lot of people wanted to be in it. But then when the 1990s and 2000s came along, well, tech was kind of the shiny job, right? And we had trouble getting people because everybody wanted to start a .com company, you know, or in the 2000s, go to work for a tech company. And I think some of that still exists today. So the industry is trying to compete for youthful talent, but they don't have as much pizzazz to compete with. So, you know.
Okay, a question. What would you say are the personality types that are perfect for certain real estate jobs? Any indicators that might show that it might not be the right path for someone? That's a tough one.
Well, I would say if you're on the brokerage side, it has to be a very entrepreneurial deal type. And I would say if this is on the mortgage brokerage side. So I've always kind of thought that you could say there's no accuracy to this, but you could say the commercial real estate sales and leasing brokerage. Those guys have to be really entrepreneurial and they tend to be very aggressive personality types. On the mortgage brokerage, mortgage banking type of side, I would say it's more of a 50-50 of those categories, a little bit less than the commercial real estate leasing side. And then if you're going to be on the credit underwriting side, where you want to be making some of the investment decisions kind of, you know, behind, really crunching the numbers, understanding the markets, then I think those guys are those are the thinkers, right? They really want to be thinkers. So I would kind of think of that. And you know, what's your risk tolerance? Do you want to spend your days, you know, going through analysis and making, you know, a lot of thoughtful decisions, or do you want to be out there making deals? And I think the mortgage banking, mortgage broker side is kind of a nice 50-50 mix of that.
Great. This question almost always comes up. Would you mind sharing your worst experience, the obstacles you faced in the industry, and how did you solve it? Or just, you know, we've all had deals fall apart. It's
Yeah. There's a product type, and I talked about it a little bit in the beginning. It's the commercial mortgage-backed security product, CMBS they call it in my industry, and that's Wall Street's tool for creating long-term mortgages on commercial real estate. It's a very complex kind of financing. What they do, instead of one lender making one loan that they're going to hold in their portfolio as investment, the mortgage is intended to be sold off after it closes and securitized, which is basically a bunch of institutions buy pieces of it. And so they put them together in these big pools, and it creates these really complex documentations. You know, if I do a loan with an insurance company, or if I do a loan with a bank, my loan documents are about a 1/2 inch thick. If I do a loan with an insurance company, they're about 1 or 2 inches thick. If I do a loan with a Wall Street investment bank, they're about, 10 inches thick. And so, the thing that they do is they won't usually lock the interest rate at the application process. Maybe it takes 60 to 90 days to process a transaction. So you have interest rate risk during that 60 or 90 days. And then you're spending all this money on due diligence. And then you get to the end and you sort of have a big fight about what the interest rate should be. That's kind of where the ugly experiences have come in. We think we're getting a 4% interest rate at the beginning. 90 days later, turning out it's a 6% interest rate, and everybody's upset. And we have a big fight and a big argument and negotiations, and emails are flying around. And then we close the loan, And then next week, everybody goes to lunch and congratulates themselves on a closed transaction. And that happens time after time after time after time again. So memories are very short.
So perseverance is a strong suit.
Yeah.
And one last question. Would you recommend to start on the sell side or the buy side of commercial real estate? Or I guess you're in the middle side.
Yeah, I think, again, I think it's your personality type. But I think if somebody wanted to learn their commercial real estate as a industry, I think one of the best things to do is either to go to work as a runner for one of the major brokerage houses, because you get a really good education there on the entrepreneurial side, or to go to work as an analyst for a big corporate type of lender where you saw a lot of deal flow. So think of Wells Fargo, Bank of America, Wall Street Investment Bank, or guys like that, where there's a lot of deal flow, because you want to see as many different types of property types and transaction types go across your desk. And in that process, that exposure will help you decide, you know, kind of where you want to fit ultimately in the industry.
But this has been great, Brad. I think you've covered the industry from A to Z and given our students a lot to think about. I was involved in the industry for almost 40 years myself, so I had a lot of what you're talking about. Yeah, that's what happens. It's been great. I really appreciate you helping. I really appreciate you giving us that list of the participants at your industry convention. And whoever wants to get that can just ask me and I'll send it to you. Send me an email. And thank you very much.
You got it.
Brad, thank you very much. We can, is it okay if we share your slides on our website, on our symposium website?
Oh yeah. I sent a copy to Frank, so it's your property now. And I should probably send you the updated copy. I made corrected a couple of typos.
Thank you again, Brad. We really appreciate your time. So we have our next speaker here, Ren Sperry. Ren, you're here? Yeah.
Hi.
Hi, Ren. Yeah. Thank you for being with us here today. I'm just going to introduce Ren briefly. He's the CEO of Sperry Equities and Sperry Global Affiliates. He has 43 years experience in the commercial real estate business. He's the co-founder of Sperry Van Ness, which became one of the top 10 real estate commercial brokerage companies in US with annual sales of $12 billion. Rand sold off his interest in SBN in 2009 and formed a new brokerage franchise, which now has 60 offices in 20 states, and just partnered with the firm in Dubai to open 24 more offices. So he's basically has offices running across 16 different countries, including South America, Western Europe, and the Middle East. Sperry Equities Partnership has over $1 billion in retail, office, and industrial assets, and manages 11 million square feet in 9 states. He's married with 6 children and 10 grandchildren and lives in Orange County. So let's welcome Rand, and Rand is going to talk about the effect of COVID on commercial real estate.
Well, thank you. Just, you left out the most important thing, and that is that I'm a CSULB alumni. So it's great to be talking to the future of our country, basically, and the world of finance. I don't know exactly what the process is. I hate to talk for an hour straight. Certainly I'll open it up for questions, but I'm happy. Frank, are you the moderator or?
Well, both Pia and I are the moderators.
Yeah, okay. So if they give you questions and you want to interrupt me on something, I'm happy to do that. I don't have slides, but what I do have, I have notes, and I could probably have one of my staff kind of convert this for you and send it to you when we're done. So I've also, just a little bit more background, I actually bought my first fourplex in 1975. So I've got 47, well, actually 48 years. I'm 68 years old. So I got 48 years in the business of owning it, and then 2 years minus to update that resume. 2 years less than that. I came right out of college, right out of Long Beach, and got into commercial real estate as a broker. And my only experience in the real estate world was owning that fourplex for the last 2 years of my college career. And it was a great experience. I had, I think I was like 19 or 20. My parents co-signed on the loan because I couldn't get the loan, but I had saved $10,000 and bought a fourplex for $45,000. And at the end of graduation, I think it went up to about $57,000. I made like 12 grand on it, brokered the deal myself, and which you can do without a license if you own it. And then decided, I'm going to go into brokerage, even though I did get accepted into law school at the time. So, and I've never looked back. It's been a great career. And Pia really had to do it to me, though. Gee, let's talk about COVID and high interest rates. The only thing she missed, though, was the online shopping and how that's affected the real estate world. But that was actually, that's yesterday's news, frankly. I mean, we were talking about that a few years ago, and it seems like that has affected the commercial real estate business, but not nearly or close to what I think COVID and interest rates have done. And so just kind of interesting, when we did go into COVID, what do you think was because we own office, retail, a few apartment buildings, and we own industrial. What do you think was the most challenging product for us during COVID? Is there a way to get people to answer questions on the way we're doing this?
Office, probably the hardest.
So office, okay. I set you up there because during COVID, office was the best product to own. And the reason is that during COVID, everyone had to work from home. So, but the tenants in office buildings, they had signed leases. Typically, it could be 3, 5, 10-year leases. And they were still making money. Typically, the people working from home, they were still productive, and there was still revenue coming in, depending on what they were selling, or finance, mortgage, those type of businesses, actually an array of businesses. I don't think we had anyone default during COVID because there was PPP money coming in, as well as the fact that the revenue model didn't really change for them. But it was retail. I mean, imagine owning a lot of retail, and I'll just talk about a couple local buildings, but we had we still do a property in Southgate. It has a movie theater in it, Regal, and it's got Curacao, which is kind of a Hispanic Sears is what I call it, basically selling all kinds of different product. They were there, and then food, restaurants, that type of thing, a gym, everything was closed. So we went from $600,000 a month in revenue to 90. So you can imagine the challenge in our debt service payment was $220,000. So that's a challenge. Whereas we had a 27 total 2 twin tower buildings in Chicago, everyone was paying the rent. Everything was great. But the retail was just sucking wind. And so we immediately had to go to the lender and try to work something out. We had to make deals with all the tenants in the retail center. And when I say this, we have about 40 LLCs or partnerships, and they may have more than one building in them. But so I think probably actual pieces of real estate was somewhere in the 60 to 70 range. And we were dealing with a lot of retail. I think we have 22 retail centers. And that was where we really spent a lot of time because they were immediately affected. And that's why they were the toughest product to own. Now, I will say hotels would be another product that was very challenging. I have a friend that owns a bunch of hotels. In fact, the Paseo one, which isn't far from Cal State Long Beach, is one of them. And Bacara up in Santa Barbara, really nice high-end type hotels. And of course, they closed down. So he had the same challenges I did. And then once COVID was over and people were going back to work, going back out to restaurants, those two products started flourishing. It was almost like turning the light switch back on. Things were great. People were back to paying their rent. And we had modeled it so that they could pay the back rent, which was about 6 months worth, over a 2-year period to a 10-year period, just kind of roll it back into their leases. What we did was, how we turned lemons into lemonade is everyone we talked to that of course couldn't pay the rent because they didn't have revenue coming in, we were able to extend their lease. So we managed to really do probably 3 years worth of work in 1 year because we were able to, for example, the movie theater, their lease was coming up, I think next year, and they extended 15 years for us to waive the rent for 6 months. And we also decided that they knew they needed a remodel. So we agreed to pitch in 10% of the remodeling cost, which was going to be, I think, or 20%, sorry, $15 million project, which you're still going to do in the next couple of years after they get out of bankruptcy. Anyway, it's Regal Theaters, and they are in bankruptcy, but they're emerging, and we're one of the ones they're keeping because we're in the top 25 across the country in terms of revenue for them. So it's profitable. But we managed to really improve our portfolio as a result of that, meaning that the average term of a lease doubled. And so we don't have, like right now, we have very few renewals going on because we renewed everybody that we could during that process. Typically, people wait till, tenants will wait till a couple months or up to 6 months prior to the lease expiring to sit down with us. And because of COVID, we were able to sit down 2 and 3 years prior to their lease expiring to extend their lease. But what was sitting on the burner ready to overheat was the office buildings because as their leases terminate, they are doing one of two things, either consolidating into a more strategic location, which hopefully sometimes is ours, or they're downsizing typically. Very few are expanding, and it has killed that market. I mean, I've got some stats here. Well, just to give you an idea what's going on, because now we're, a couple of years out, so leases are starting to expire, and we don't see it getting better for another 4 or 5 years as all the leases terminate, and some maybe 7 or 8 years from now. We're going to see some real blood in the water, I think, with office buildings. So, in fact, I was reading a statistic that if your building is older than 2015, so if it's more than 6 to 10 years old, you could be in trouble in terms of being able to compete with the newer buildings that were built before COVID. And the reason is because, for example, our building was built in that I'm in right now was built in around 1988. But the landlord, we don't own this building. It's a 17-story building in Irvine. They went in and they put in a beautiful coffee thing downstairs. They spent $2 million doing that. They put a gym in. They put in a billiard room, a lounge area. In other words, they took their basement and probably added a couple $1 million of tenant improvements there to keep tenants, and it worked. I mean, we renewed last year because the place looks great. They have bocce ball, they have outside, they've got all kinds of chairs and umbrellas and places to eat, a beautiful waterfall. They've got a putting green, all the amenities that would attract a tenant in today's market. So if you're doing things like that, which we've done in a building we own in Chicago, which I'll talk about in a few minutes, you have a chance of survival. So you combine the fact that your office buildings are going down in occupancy, and our firm is projecting a 20 to 25% drop in the aftermath of COVID, which is huge. Now, CoStar is projecting somewhere around 17 or 18%. And we honestly think we're being conservative at 28%. Maybe that's because, we're in the middle of it, and a lot of the properties we own, as was mentioned, is in 8 different states. So we've got a broad flavor for what's going on nationally in the office market. So it might be more in the 13 to 15% here in Orange County. LA, they're projecting about 16%, but I think across the board, East Coast to West Coast, it could be as high as 25%. And it's just going to be a challenge to keep them. And then you combine that with the next marching order I had is what are interest rates doing to affect the market? And let's say you're locked in right now at a loan at 3.5 to 4%. Well, when you go to, can you imagine, let's say you're 90% occupied, this is pre-COVID, on your office building, you do some nice amenities, but you're 90% occupied, you go out and you get a 4% loan. And Brad may have already talked about this challenge, and that is now your loan's coming due and the rates are now 6.5%, and and your occupancy dropped another 10%. Guess what? It's 2008, 2009 all over again. You can't refinance. Even if you can make the payment, you can't refinance because you won't get the loan to value that you need based on the new appraisal and based on the higher interest rate, because a higher interest rate eats up your debt service, which gives you a debt coverage ratio that doesn't work for the lenders. Meaning it's too low. You don't have enough cash flow to cover the debt service and have money in reserve. And that's what they want to see. They don't want to see that you're just covering your cash flow. They want to see that you have money in reserve. So that's going to be the biggest challenge for owners of office buildings, including us, as vacancies drop or get higher, and interest rates stay. If they just stay where they are, we're going to be in trouble when we go from a 4% loan to a 6.5% loan. Now, one of the key, go ahead. You got a
I'm
question?
sorry, there's a question from a
Sure.
from a student. So they would like to know why are the newer buildings preferred? Is it because they serve various purposes, like you're saying, they have gyms and bocce ball courts and all that, and the older office buildings are just buildings?
Yeah, that's exactly it. The amenities that that the newer buildings attract. And look at, who their customers are, their tenants, their future tenants are the 87 people on this phone call here. You tell me, what would you like if you had to work in an office building? What kind of amenities would you like? Do you just want to go up to your office and hang out, or would you like to have, putting green down there, or lounges, billiard tables? And obviously you're going to work, but you do get breaks. And a lot of the different industries we're in, people, they're more productive if they have an opportunity to blow off some steam. And so a lot of employers actually encourage them to go at lunchtime and work out in the gym. There's showers there to change, there's billiards. In fact, in this building, they gave you a thing. You get 2 free beers every day. It's on an app. It gets you into the I want to call it a clubhouse, but in the basement there, it's called the hub, and you also get 2 beers. So we're really catering to the millennials and the Gen Z, and that's really our future in terms of tenants and attracting them back, because I think long term you're going to see that office buildings and working in office really does send a positive message in a work environment, because it's so important to have collaboration. And when we have brokerage offices, and I couldn't imagine try doing a startup brokerage operation out of your house and having everyone remote. It's impossible. You need to train and mentor the people. And that's almost so many different businesses use insurance. You're going to learn the insurance business. You need to be in an office where somebody's been in the business 20, 30 years and can train you. And you just can't do that with Zoom calls and Zoom conferences. So Zoom, serves a purpose, like what we're doing right now. None of us needed to travel to Cal State Long Beach to get this information today. But if we're going to grow our companies and make sure that our culture trickles down to the people that work for us, then we need to be in the same room. It's kind of like a family unit. It'd be the same thing. How would you raise a family if each one of your children are in casitas down the block and in different areas? Now we can't do that, or Child Protective Services will be all over you, but I'm just saying it is really the same kind of situation. You really need to have those people, and ideas, that's where they come from. They come from collaboration, and you're just sitting there having a chat at the water fountain, and you're talking about a problem you have, and the other guy goes, oh, I've had that problem. Here's how I solved it. That's not going to happen if you're working out of your house. And also employers have found, it's kind of interesting. There's some stats on that, which, I'll send, but it's kind of a 50-50 now. A lot of employers are trying to pull their people back into the office, and for the reason that I mentioned. But, there are some studies that show people actually are more productive at home because it's typically the really well-disciplined and kind of workaholics that are more productive at home, because they just zero in on what they're doing and there's no distractions and they really can get a lot more work done. But a lot of employees have families and they're working out of the house, and maybe the kids are young. There's just all kinds of distractions. I was on a homeowners association call a month ago, and we were on a Zoom call, and the one responsible for our neighborhood had to leave the phone call to pick her kids up. Now, the interesting thing is, if she worked in the office, employers wouldn't have any of that. You couldn't just say, hey, I'm checking out, I'm going to go pick my kids up, or I'm going to go run errands, where that type of stuff does happen. So the other part of the results that were shown was that about 75%, I don't know if you want to call it abuse, but you're not getting 8 hours out of them, because they are doing things when they should be at work. In fact, we were skiing up in Mammoth President's Day, and one of the couples we were with our children and their friends, and she worked for a film production company. And after we got done skiing on President's Day, she realized that they didn't take that day off, that she thought it was a holiday, and she checked in and they didn't even know she was gone. They had no idea. She goes, well, that's pretty interesting. She goes, I got a holiday and I got paid for the holiday and I didn't know it wasn't a holiday. So that's the kind of stuff that can happen when you're working out of the house. And I know most of you will start your career working for somebody, but there will be a day, if you're not already, being the employer. And so, if you try to look at it from the employer's side, they're paying you to be at work and to be collaborating and working and creating ideas. And it's hard to monitor that at home. Now, there are a bunch of jobs where you actually can monitor productivity. In fact, we have several jobs like that have to do with the management side of our company, and basically entering lease abstractions into Yardi. It's a technical thing, but so they can do that from home, because we know how many they do a day. But typically, if you're growing a company, an entrepreneurial company that need, and especially if it's a sales company, I don't know how you do it. Back office type stuff is another one that potentially you can do from home. We had Jenny Craig on a full floor in an office building we own in Kansas, and the entire, after COVID was over, they figured out they don't need the office space. So the lease was up. They didn't say we want to shrink down. They eliminated us. Their back office all work from home. And I think it's probably very effective for them. But that really kills an office building when these tenants, they don't renew and they go away. And right now with inflation, actually, Pia, you forgot to add inflation. So inflation has really killed office, in that the biggest challenge with office, and why I don't really like it, is that even if you get a good price for it, the turnover in the building can be very expensive. It used to be 40 or 50 bucks a foot to renovate space for a new tenant because they want it custom based on the business they're doing. And now it's probably double that. Just in the last, since COVID began, it's almost twice as much money to renovate a floor than it was. And so that's another cost added to office that really eats into the cash flow. So I don't know. Any other questions about the office market that you've been wondering or have a comment on? I've got some stats here. Pia, has anyone got any questions before I move on?
No, I think people are just digesting the information. I'm sure they'll come up with questions, but if you can share your stats.
Oh, Rand, let me ask you a question.
Sure.
Where are you seeing office markets more robust? Here in the US, overseas?
Well, I haven't looked internationally, but basically the high MSA areas are a little more robust than the suburban market areas. Those are the ones that are really dying, so to speak. And a lot of it is, but, you know, in fact, downtown Chicago, I have a place down there in a high rise, and I could see 2 offices on each side of me, and I rarely see people in them. And so I'm kind of wondering, you know, it hasn't hit the fan yet because there's so many tenants on long-term leases that I don't think it's affected them. But we're seeing the numbers right now show that in the last year, we've gone from about 1 out of 3 workers to 50% of the workers and employers asking them to come back to work. So we're looking at about 50% of the lease space, workers are coming back. So it still means you're going to get a great parking spot in the structure, but it's getting a little harder. And that's one way to really notice it. In fact, I was just at somebody's building earlier this morning, and I noticed that the first floor all the way up to the second, third floor of the structure was full. It's like a 6-story. So that one is probably about 50% occupied. And so, but when you say the most robust, I don't know that there is a market that's robust in office. Absorption, to give you an example, was a negative 27 million across the country this last year. So that means not only did we not absorb, we had a negative absorption. So it's really a challenge. And as you may have heard, I don't know if you've heard this or not, but it was in the news, PIMCO, who bought, and it's amazing because it was in 2021, they bought this portfolio for 3.9 billion. And it's primarily, you know, the larger MSAs around the country. And they took out a $1.7 billion loan on I think there were 17 properties. 7 of them they've defaulted on, a total of 1.7 billion. And you know what's going on is the vacancies have dropped, the loans are due, and that's why they're defaulting. They can't get a new loan to replace the existing loan. And so, you know, these buildings are going to be foreclosed on, and they're going to go for 30-40 cents on the dollar. And the last recession in 2008, and there was one in the 90s. And I remember it was kind of funny. We do these proposals, these analysis on office buildings, and we found that the valuation of the office building equaled the cost to build the parking structure. So it's like, buy the parking structure, get the office building for free. And I really think we might be going back to that. I will give you an example of one that we own in Schaumburg, Illinois. We currently are 52% occupied. Now, we knew we bought it knowing that a major tenant was going to move out and left us with 4 empty floors out of 27. But we thought we'd backfill that pretty quickly, and then COVID hit and we went the other direction. We went down to 42%. So the interesting thing is we've picked up 10% absorption in the last 9 months. So we're actually doing well, but let me tell you what we did. We did exactly what they did in this building. We put the gym in, we put the arcade in, we redid all the bathrooms. We made it attractive and comfortable for people to come. And the work environment is, they have a cafeteria. They've got 3 big different size conference room with huge screens in it. So the tenants can use those for meetings and training and so on. And so we believe we're going to get back into the 70 or 80% occupancy. The crazy thing is this building was bought by Donahue Schreiber here in Irvine, before we bought it, before COVID, and they lost it in COVID. They paid $95 million for it, and we bought, and it had a $60 million loan on it, and we bought it for $32 million. Now we put $5 million in it, but I'm going to tell you, if I were to get the parking structure appraised, the parking structure is probably worth $30 million, and you get the building for free. So in fact, we just got the building appraised, and it's down to 25 million, based on the fact that we've got the occupancy has dropped. Actually, it's gone up 10% since they appraised it. So we might be back to even now. So we're struggling, and we bought the building for 65 bucks a foot. It would cost $300 a foot to build this building. So that's the challenge we're having right now with, you know, this type of product. Rent growth actually projected for next, let's see, for this year, 80.2 billion, or I'm sorry, sales. Sales were 80 billion this last year, and normally they're triple that. So we're projecting 70 billion for 2023. I mean, sales may be going up in the next 2 or 3 years, but not because they're making money on the building, it's because they have to sell the buildings. So it's pretty challenging if you own that. Now, let me talk a little bit about retail.
Rand, can we ask you a couple questions?
Sure.
One of the questions how did supply chain disruptions affect the pricing for materials during COVID?
Well, I probably should have mentioned that. That is the reason for the doubling of, I think, of the cost to do construction. And we do, it's internal construction, it's tenant improvements. We actually are not developers, with the exception that I'm personally building a 63 unit apartment building, retail on the bottom, and 63 units on 6th Street, just a mile west of downtown LA. And we are 1 year off projected opening. We should have been open today. We're lucky to be open next January. And it's just because we can't get certain things that just stop construction. So it was the wiring for the building that was holding us up, and still is. And then we had issues with lumber, as you know. Lumber, what did it triple in value? And now it's come back down, but it's still not where it was, like at 800 a board foot. So that's been a challenge. I would say that every developer is having that challenge, because it's getting better, but the problem is that when you're building a building, any type of building, let's say everything's going great, but you can't get faucets. I don't know, use that as an example. Appliances actually is a good example. That'll delay you. And they said, we won't have them for 2 months. Well, you can work around it as much as you can, but it obviously is going to delay you and the opening. And, you know, when you have a construction loan, it's costing you money to not be open. So, and then the interest rates are really playing a factor in construction right now, because a lot of people projected interest rates maybe at 4% when they, you know, broke ground 2 years ago, and now they're going to come out and they're going to be 6.5 to 7 on a long-term loan. So it's going to be interesting to see what happens there. And you can't really get construction loans right now. I don't know if Brad talked about that much, but it's a challenge because the rates have almost doubled in a year, and that's just insane. I mean, I've never seen anything like this, where we're gonna grind down the industry overnight. I mean, every time they'd raise it 1/4 of a point, and then it was a 1/2 a point, and another 1/2 a point, and another 1/4 point, and a 1/2 a point. It's like, basically, you're putting the kibosh on all sectors of real estate, from development, brokerage, sales, architectural aspect, anything that trickles down into the development of real estate is getting affected by these interest rates. And really, you need to have all of us on a year from now to see what it really looks like. We're still a little early into it to see how bad it's going to get. But, there's pros and cons to it. I mean, I'm building an apartment building, we'll be done. There are probably 6 other ones that won't be built because of interest rates. So that might make rents go up and fill me up quicker than I would have if, 6 other buildings would have went on the market at the same time mine did. So there's pros and cons depending where you are in the cycle, whether you just broke ground or you're finishing your project. If you've locked in interest rates or you didn't, you're gonna be painted a totally different picture in that
Well,
sense.
given that, this is a question for me. Because yes, I think it's the shock of the change of interest rates that's the biggest thing, because as someone who's been around for a while, 6% interest rate, 6-7% is not abnormal. How long do you think it will take the market to adjust to our, I guess, new normal? I sort of hate that term, but
It is the new normal, isn't it? I mean, I don't see rates going back down to 3 or 3.5. I never thought they should be, because what happens is when you lower the rates and you keep them low for like 15 years, that your whole mindset, no matter what business you're in, is that you adjust your budgets towards the fact that your rates are 3% or 3.5%. I just got, before the rate hike, my last loan was 3% on an industrial project we have in Salt Lake City, a good size one. I was pretty excited about that. But so they went down to 3% on commercial real estate, and you get adjusted to that. And families, for example, buying homes, they're like, okay, we got qualified at 3%. In 5 years, it might be an ARM loan, adjustable rate mortgage, and that's going to go to 6 and 7%. So I guess the thing is, we're not going to get adjusted to the new normal until the majority of loans we have right now, and there's a lot, because the mortgage brokers were working really hard the last 10 years refinancing and getting those low interest rates pegged in, and everyone was getting used to that. And then all of a sudden your mortgage payment, let's say on your house, doubles the minute you're done with your fixed rate period on your loan. So it's not a 1 or 2 year thing. It will be for new people coming into the business, meaning that it's your first time. You're going to go out and buy an apartment building as your first investment, or you're going to develop. You're going to base it on current interest rates, so you know exactly what you could pay and what you can't pay. And for example, using apartments, the basis of the cap rates have gone right now. It's gone up 50 basis points in terms of the cap rate across the country. And you're going, well, gee, I would have thought rates were 3.5% on apartment building. They're now, 6 is about right. 6% depending on who you go to. How could a cap rates only go up 50 basis points? Well, it's because the market hasn't adjusted. The people that think their property should be a 4 cap, they're just not going to sell, and they're locked into great interest rates, so they're not going to sell. So the ones that are selling are the ones that have to refinance right now, and so they're going to be adjusting to the new norm of those new rates. If they either keep the building or a new buyer comes in and buys it, they're basing it on the new cap rate, and that cap rate is going to continue to go up as deals happen, only because the interest rates have gone up. We just haven't felt the full effect of it. So to answer that question, I think it's going to take at least 5 years for not the mindset of adjusting to it, but based on the real estate that has been purchased, that loans have been committed, that are in term right now. Like our loans, it's 3%. It was a 10-year loan. So if that was the only thing that I owned, I'd be, I wouldn't even be worried about interest rates, right? But that was a lucky deal. We've got plenty of them that, the fixed rate's going to go away in the next 1 or 2 or 3 years, and some that already have. And we've got to adjust to the new norm. And I'm like you. I mean, I got in the business in even 1975 when I bought my apartment building. I'm sure the rate was at least 9%. And as you know, in 1981, prime went to like 19 or 20%. And had it stayed that way, it would have been devastating. I think it only lasted a year or two, and then they came down. But they only came down to like 12 and 9, 10, 11. No, I think it was 12% in the early 80s. And we just got the prices of what you acquired adjusted to that new interest rate. And so that's what has to happen for it to be the new norm. We have to see, and right now sellers aren't having anything to do with it unless they have to. And buyers are like, I'm not going to buy your building at a 5 cap and I'm going to go out and borrow at a 6 cap. And that's the challenge right now, is that you've got sellers that are disengaged. They're not going to sell unless they have to. And buyers who are like, I can't make the deal work at the old cap rates because the interest rates have gone up so much. So, it's funny because when I got into business, we were still selling negative leverage properties, which is basically where your cap rate is, you're borrowing money at, let's say back then, 9%, but the cap rate on the building was 8. So, it was costing you to buy that building in the sense that you weren't getting as much on your money as you're investing. You're borrowing at a higher rate than the return is. So that's kind of the market we're in now. I got to tell you, we had a great time right after COVID. This was a great recipe for investing. People were afraid of retail, but we had already got a sense within 90 days. It was like the light went on as people came back to restaurants and people started shopping again and so on. Our buildings cash flow went back to normal, and rates were in the 3.5%, 3.75% rather. And institutional sellers, we bought $100 million of, I think it was 120, 4 buildings. And we bought them between a 7.5 and an 8 cap. And we were borrowing at 4. I mean, so we obviously still own those, and we did long-term fixed rate loans on those. And, they're just cash flow cows, because talk about positive leverage of 400 basis points, just amazing. But I don't see that. I mean, I hope someone doesn't ask me, well, right now, what would you invest in? I'm not sure. I think it'd be retail. We're still buying retail because that market is adjusted due to COVID. People are afraid of retail. Owners get it. In fact, they've been through it where they didn't get any rent for, let's say, 9 months, maybe a year, depending on the tenants they were working with. And so when the market finally freed up, they were like, okay, you can take my building at an 8 cap, I'm out. And right now I'm under contract, $21 million deal in Tempe, Arizona, and we're buying it at a 7.5 cap. Now, they did come down. People started realizing, well, retail's pretty good cap rates, let's buy them. But that one probably before rates went up would have been a 6.5 cap. So
it's a good, we had a question from one of the students. Obviously, you don't believe that online shopping is going to kill retail, but the other thing is how it affects industrial space.
Oh, well, it's created a huge demand for industrial space because, and I'll give you an example. I'll do a little commercial. My son-in-law and daughter started a company called Built. It's BYLT. You guys write that down because you'll probably like their clothes. They're for for young people basically, but I wear them. And he started off in 2,000 feet. Then he went to 15,000 feet. Now he's at 100,000 feet. And this is all in a span of 5 years, okay? And if online marketing didn't exist, he'd be working for somebody right now, doing something. In other words, he wouldn't even have that business because, online and social media and the things you can do to spread the word about your product is the best way to grow your company. So, he's probably affected, a lot of the TJ Maxx and those type of companies that sell discount clothes. He's affecting that market. Online does affect the big box. We won't go in and buy a building with big box tenants that are being challenged by online shopping. But the thing is that most of the retailers have embraced it. And in fact, you can go into many of the top retailers in the country and buy their product online. And a lot of them do have fulfillment centers in the back of their stores. They've reduced the square footage where you walk around and put fulfillment centers in the back. And so they figured out how to be part of the online. In fact, about 22% of all shopping is done online right now, projected to go up to 29% in the next 4 to 5 years. But guess what? Big retailers are 50% of that. That's counted in the numbers. So they've kind of joined in. So so the ones that have done that are going to probably survive the online market. So and look at the food places with Grubhub and DoorDash. The restaurants are doing more business now than they did pre-COVID. And that was the thing that we found interesting is we would buy a shopping center. We say, how are you compared to pre-COVID? Every single tenant we interviewed, and this again, $120 million worth of product. I think every single one of them said we're doing better. They were up 10% up from their 2019 numbers. So online, serves a great purpose and it's affecting some people. It's also making multimillionaires out of others. So it's kind of like if you own a horse stable back in 1900, unless you figured out you're going to start racing your horses, you'd probably be out of business in 20 years when Henry Ford came out with, the Model A. So if you don't pivot, you're out. And a lot of the retailers pivoted and they're still in business. One of the things that does make me nervous from time to time is, for example, we do have gyms and, Planet Fitness is very popular, 24-hour fitness. They're doing extremely well in our properties, but COVID scares me when it comes to them, because if you have another bout of what we had, boom, they got to close their doors immediately. There's no way to work around that. So, but, I got in this business taking risk and I continue to do that, I guess. So we'll figure our way out of it no matter what happens. After COVID and high interest rates, the dot-com bomb in 2000, the mortgage thing in 2008, all those industries were in our buildings. And, we managed to survive through that. And one thing I have to say, and you've heard this before, it's all in the buy, meaning that if you buy it right, you could survive. And going back to our rocket scientist, PEMCO, who maybe needs to get out of the real estate business, they thought they were being really creative when coming out of COVID, they leveraged to 81% loan to value. And so, of course, the minute things get a little rough, we wouldn't do that. We have an equities division and we put 40% down. And the other thing that we do, for example, going back to Southgate, I didn't mention this, but we had $2 million in the bank. We don't distribute every dollar we have. We keep it. When you have a $225,000 mortgage, you better have 6 months to a year sitting in the bank, especially if your name's on the loan, which it is on that deal. And so we were able to, that's how we really survived that. We were able to make that payment through the cash we had on hand. And I even look at, yeah, go ahead.
Over leverage is always bad.
Yeah.
Well, the problem is it's not, in other words, in a rising market, if you can get in, if you can buy $100 million of real estate for 20 million and it goes to 200, you're like, I'm golden, right? But the
Right.
problem is that if you end up where rates go almost double in 1 year, that $100 million portfolio goes down to 60. Now you're 20 underwater. And I mean, just add a zero or two to it. And that's what PIMCO did. And so did Brookfield. So it's like they were trying to take advantage of what they thought was a falling, what they did is they caught, you don't want to catch a falling knife, right? And that's what they did. They thought, oh man, these are good deals because they came out of COVID and people wanted to sell. So they leveraged up. In other words, it's kind of like double down. And I never wanted to be in that situation where feast or famine. I've got a lot of friends that, were worth 100, 200 million. And then 2 years later, they're living in an apartment. And some of them have actually come back from that scenario. But as mentioned, I had 6 kids, and I decided that I'm gonna play for the long game, the conservative game, and slowly grow my wealth. And in fact, even the home we live in, it's a very nice home, but I've had it now for 26 years, and so I like being able to sleep at night. I love doing the business, and it's kind of funny that I think the more you have and the more you can accumulate, the more fun it is, obviously. But you got to be able to sleep at night. And, a lot of people, I think, especially the younger generation, and I say that in every generation, it was my generation too when I was in my 20s, and that was, I'd like to be retired by the time I'm 30 or 40 or whatever. And so you kind of get into this, you push the throttle too hard. Kind of reminds me of Top Gun. You remember the beginning scene, most of you have probably seen it, where Tom Cruise or Maverick is in that stealth rocket or plane. And he got to, they had to approve, 10 Gs. And of course, the plane was barely built for that. But that's all he had to prove. That's all he had to do was prove it, and the program would have continued. But no, he had to go 10.1, 10.2, and at I think 10.3, the plane blew up. So, and he ejected. And that was the beginning. So it set the pace for the movie that he's a risk taker and he's just going to keep full throttle. Well, I'm a risk taker, but I'm like medium throttle. And I think if I could give any of you any advice, it's do that. Even my son-in-law, in building his company, he was doing really well even the first 3 years in the business, but he bought a very moderate home, and it was because he took every dollar that he had and he put it into back into the business. And he was very conservative, of course, with me pounding on him. And so he has no debt, and he does 125 million a year, and he thinks he'll be at 150 million this year in sales on an online internet product.
Great.
So that's, if I could give advice to the young people out there, it's come up with something, be passionate about it, work as hard as you've ever imagined you can work, 12-hour days minimum. I mean, seriously, that's what it takes to make it in this business. And then, but don't go full throttle in terms of the risk you take. It's not worth it, in my opinion. I mean, I'm looking back now, 45 years looking back, and I was very envious of some of my fellow buddies that didn't have a financial statement that I had getting in the business. And, before you know it, they're doing extremely well. I'm doing well, but they're doing extremely well. And, a lot of them ended up like Tom Cruise, in the old diner there, wondering where the hell he was. So I wouldn't want that on my worst enemy. So I do preach that to my kids, and they get it. They see it through example. They know I can afford other things that we don't have. And it's because you never know when that rainy day is coming. And Pia, you just described the rainy day. I can tell you that. Let's see, COVID and high interest rates. You mix, that's a what kind of cocktail do they call those? It's like a suicide cocktail. So, gotta be careful there.
Brad, what courses did you take in college that were most valuable, and what would you suggest students take if they wanted to get into your world of real estate?
really good question. I'm glad whoever asked that because I went, and I don't know if you still have it there. It was the finance/real estate. And in the real estate part, there were 5 classes and like appraisal and law. And I don't know, I can't remember what they were, but Cal State Long Beach actually designed the program. When I walked out of there, that and, managing a 4-plex was enough for me to get in front of a client and tell them what to do and what not to do and what could be a problem and what couldn't be a problem. And I really do contribute that to my training at Cal State Long Beach. So I am, in fact, if you take that, you come out qualified to take your broker's exam. And so I actually waited a year before I took the exam. I went out as a salesperson, but I'm glad I never I waited 10 years before I opened my own brokerage office. And as was stated, even today's, it's now called Sperry Venice, is called SVN. It's ranked number 7 in the country. And, I hope to knock it off its block with mine. But at this point, it's a very successful organization. And I really owe it all. I mean, my partner is a high school, Mark Van Ness on that, came out of high school and, he went to the University of Hard Knocks. But I went to Long Beach and I got a great education and met a bunch of people there that were, it seems like back in the late 70s, real estate was a hot thing in that school and in that market. And it really, because I was just preparing to go to law school and I kind of pivoted towards the real estate. And because it's fun too. I mean, I just love the people I meet. I just got off the phone, by the way, with another Cal State graduate. He's 20 years behind me, very successful, Goldman Sachs, and high net worth advisor to his clients. Backgrounds, Cal State Long Beach. And there's so many other very successful people that have come out of that school. I think was going to the movie side, wasn't Spielberg? Didn't he go to Long Beach?
Yes.
Yeah.
Yes, he did. And so talking about your career, Rand, so one of the students would like to know if we can get a quick timeline of your career over the years.
Well, okay, first 10 years, I was with an apartment brokerage company. And by the 5th year, I was running the company for the owner. I was 26 years old. I also was buying a 4-plex, an 8-plex, a 16 unit. I accumulated $1 million of net worth that I could have easily turned into cash, but I continued investing it. At the age of 26, my goal was 30. And then after the 10 years, almost to the day, myself and a guy named Mark Van Ness opened up Sperry Venice in 1987. And the stock market crashed, I think 3 weeks later, and there was a major earthquake in Whittier that year too. And we go, is this an omen? And so there's always going to be those obstacles. And then in every year or so, we opened an office. We got to 6 offices in Southern California that we owned and operated. We'd have 25 to 30 guys in there. We implemented training and mentorship in each office and created a lot of multimillionaires. We decided to expand the company across the country through franchise. So of those, 1,000 brokers and at the time, I think 180 offices, they're now at 220. So we're the size of a Marcus and Millichap, but we don't own the offices. They're we get royalties from them. So that happened in the year 2000, but back up 2 years. And that's when we started taking high net worth individuals that I'd known and become friends with, and started investing in the commercial side, meaning office, industrial, some apartments, and retail in Southern California, then started expanding into other states because we had offices there and guys would call up and say, I got a really good deal for you. And then we knew we could trust them because we trained them and worked with them. And so through those relationships, we bought some pretty nice properties across the country and made a bunch of money doing that. And that's 1998 to current. And then, but in 2000, we started the franchise. And by 2006, that's when we had 1,000 people in 180 offices. And my partner wanted to retire. I didn't know what to do because I started the equity side. So I said, okay, we're going to swap shares. I'll take your interest in the real estate. You run the franchise operation because that's not that hard to run. You can run it with 15 people. because now you're running a platform supporting the brokers out in the community. You're not actually managing them. And so, so he did that, and I had trained a guy to run that company. And so, and he still owns it. And, you know, I'm the major partner in the equities and commercial side here. And now my non-compete left, so I was able to start my brokerage company, which was about 4 or 5 years ago, but it's a franchise operation. Similar platform, could just cost less to join and to operate. So that's pretty much it. Got married, we had 6 kids. And I think, you know, family balance is so important. 5 are married, 1 is engaged, 10 grandchildren with 1 on the way. And they're all actually pretty darn successful people. I'm very happy with the result with the results. I mean, they all have very nice lifestyles, and not because of me. I gave them a start, but they took it from there, and great kids, and they all get along. It's really, so I couldn't be happier with the way things turned out. And I do owe a lot of it to Long Beach. I really do. They really helped me with my start.
Thank you. We really appreciate that, Ren. And on that note, what would your advice be to a 20-year-old that wants to enter the commercial real estate industry?
Well, I think Brad kind of made a comment, and it's true. You need to find your niche. I mean, not everyone's cut out to be a broker. Not everyone's cut out to be a mortgage broker. It's different than being a real estate broker. There's property management, there's asset management, working for big companies out there. There's a lot of real estate REITs that are looking for young, energetic, smart people. You typically will start out as a financial analyst. So if you really want to get into it, you really got to know your numbers and understand how to analyze real estate. So a recommendation would be to take classes and really understand how the product works. And with that knowledge, then you can decide probably really what direction you want to take your career. So find organizations that, for example, like me, because I owned a fourplex, I went to work for an apartment house broker, but I had already figured out that I get it, I like it, I made money, I was passionate. So I sought out a guy, and his name was Bruce Haynes. I don't know if anyone's old enough to remember that name. And he had 3 offices at the time, and we grew it to 6, but we were all apartment brokers in different markets. And it was a lot of fun. I knew that product backwards and forwards. And so find your passion within the real estate sector. Don't think that real estate brokerage, commercial brokerage, is the only thing out there you could do in real estate. But it's fun, and you can make a lot of money. I mean, the people that work really hard are making 7 figures. It's crazy. Back at Sperry Van Ness in the day, we had one top earner was 7 million. To be in the top 20, you had to make over north of 2 million to be in the top 20. And, you know, again, I got out of it in 2008 or 9. So those were big numbers back then, and they are today. So you could do really well. Don't settle for less. Really stretch yourself and your imagination, and you know, it takes good training. So find that company that's willing to invest time in you and pay them back, and then move on, or take over the company. One or the other. Any other questions? Or are we out of time? We're out of time. 3 o'clock.
Yeah, unfortunately, we're out of time, but this was very interesting. I think we all learned a lot. I would have loved to talk to you a little more about Dubai commercial real estate, because I actually grew up there.
Oh,
And
really?
it was, yeah, so it wasn't, you know, as booming when I was there, but I did go back there a couple of years back, and it had completely changed.
Oh,
It just looks like a city out of science fiction, you know? Yeah.
It does. Well, we
Yeah.
can talk about it later, but the crazy thing is they'll build it and then figure out how to fill it.
Exactly, and
That's
that is
crazy.
that was going to be my question, because I did talk to a few people, you know, because they have the money, right? So they
Yeah.
just build it first, and then, so I would love to chat with you about that at some point.
By the way, China, Beijing, and Shanghai have built these huge cities with schools and everything, and no people. And you know, with the anticipation they'll come, but they'll build everything, the whole
Right.
community out before they have any people. But they have the money. So
Right.
it's the government backed. So
Yeah.
anyway,
All right, thank you again so much, Rand. I hope we can keep in touch.
my pleasure.
Yeah.
Yes, absolutely.
Yeah,
Thank you. Good luck, everyone. Bye-bye.
thank you so much.
Mhm.
Right, so we have our next speaker here, Racquel Davidson. Hi, welcome, Racquel.
Hi, can you guys see me and hear me okay?
Yes, we
Yes.
can.
Yes.
Hi.
Hi. Thank you so
Thanks
much
for
for
having
being
me.
here and
Oh, Raquel, I'm thinking that the way we change the schedule around is actually perfect. 'Cause
Okay, perfect.
we've heard from the two people that have been in the industry for 40+ years. And now we come to you, the new
Yes,
person in the industry.
much newer.
Who can answer the students' questions more directly. You know, it's hard to say, well, yeah, how do I get to be a multimillionaire in real estate?
Yeah, I
Listen.
signed on for the last 10 minutes and I felt like I got some good nuggets myself and I
Yeah.
wish I listened to the whole thing. But yeah, I'm definitely newer into the industry. I'm on my 7th year. So hopefully I can share a different perspective for everybody. And yeah, so should I get started?
yes, please.
Sure.
Okay. Do I have the opportunity to share my screen
Yeah,
here?
you should be able to, Racquel,
Okay.
your co-host, so you should be.
Okay. Bear with me. I don't do Zoom a lot. Can you guys see my screen?
Yes.
Okay, perfect. Okay, so I put together some slides for everybody. Hold on. Oh. All right. So hello, everybody. My name is Racquel Davidson. I am a residential real estate agent with a brokerage called Compass. I have been in the business for 6 to 7 years now, and I service buyers, sellers, and renters all across Orange County and Long Beach, and occasionally Los Angeles if my clients need me to be there too. And I am super excited to be here today because I went to Cal State Long Beach myself. I graduated in 2017 with a business finance degree. So this is a really fun opportunity for me. I'm really thrilled to be here today speaking to you all. And so I'm going to split my presentation into 2 parts today. For the first portion, I'm going to talk about my career path, getting into real estate, how long it took me to find success, what my income looks like today versus when I started, pros and cons of being in the industry. It's not like what it looks like on TV, I swear. And second, I'm going to be diving into a brief overview of what it looks like to buy your first home. Not only am I a realtor, but I did just make my very first purchase 2 years ago. So I can share from personal experience and from being in real estate the steps to that process. If you are thinking about buying in the coming years, whether it be personal property, investment property, and if you're not, it's just good things to know. You might surprise yourself. A lot of people think that owning a home sounds impossible, and it's way more achievable than you would think. As long as you have a good team educating you, you might be closer than you think. So I definitely want to touch on that. So let's dive in. Please enjoy this photo of me from Cal State Long Beach when I graduated in 2017. I thought that would be fun to include. So my career path, I was in school at Orange Coast College. If you're familiar with it, it's a local community college, and real estate was not on my mind at all. And I was working for a local builder in Newport Beach while I was in school. And he asked me if I would be willing to get my real estate license and sell his spec homes. And if you're not familiar with what a spec home is, he would go out and buy a property, tear it down, build a luxury home and sell it for profit. So I was 21 years old at the time, and I thought that sounded awesome if he wanted to help me do that. So I said, sure, why not? I enrolled in my real estate courses and studied for my exam while I was at Orange Coast College. And when you're doing your real estate courses, it is 3 different classes. Most of them right now are online, but when I was doing it, I was able to take 1 in person. But you take 3 courses, you have to pass all 3 and get 3 certificates. so easy compared to what the stuff you're studying now. And then once you have those 3 certificates, you sign up for your big exam. And I took that exam in July 2016 and thankfully passed on my first attempt. And you will find out if you pass right away. They send you into a room, and as soon as you're done, they print your results, and it's on a piece of paper. You walk out of the building and you open it up and you know if you passed. So it's, I think you need 70% to pass. So I did pass my first try, and then I transferred to Cal State Long Beach. And that's where things kind of got a little weird. The builder did not provide any direction for me. He didn't really give me any next steps. He was just kind of like, cool, you passed. And nothing really came of it. So I waited a few months, and then I ultimately decided to start interviewing at some brokerages, because you can't do anything with your real estate license unless you hang your license somewhere. So I decided to join First Team Real Estate in Newport Beach. I knew somebody there, so it felt like a good fit. So I hung my license there in November of 2016. And when you join a brokerage, you are not an employee. You are an independent contractor. You're running your own business, but you're under this umbrella of the brokerage or the company. So you do not get health insurance. You do not get a paycheck. You do not get benefits. You're actually paying them. So when you join a brokerage, you're actually going to be negotiating a split. So I think mine at First Team, because I was brand new, no experience, was 65%. So if I had a deal and I was getting my closing commission check, I would only get 65%, and First Team would keep the balance of it. So just be aware, the brokerages take splits, and you're not really getting much from them, and no benefits, no insurance whatsoever. So I joined First Team, and I started my real estate business pretty slowly as I was working for that builder about 30 hours a week. I was full-time at Cal State Long Beach, I think 4 or 5 classes, and I was also teaching dance classes. So there wasn't a whole lot of time for real estate. I did it in the evenings and on the weekends. So it was a very grueling schedule. I think that first year, I finally decided to start putting in some effort around April. I held my very first open house, because that's how a lot of new agents get business. You find an agent in the office who has a great listing, and you hold it open, and you hope that a buyer comes in and doesn't have any representation and wants to work with you. And so I held my very first open house in April of 2017. And a buyer walked in and did not have an agent and asked me to represent them. That is so rare. It never happens. But thankfully it happened to me on my very first deal. So that was a really cool moment. And other than that, I didn't do any other deals until the fall. I think I had 2 in the fall. So 3 transactions total that first year, with just kind of doing it on the side. So I felt pretty impressed with myself for getting some extra money and closing a few deals. So after that first year at First Team, I was getting ready to graduate Cal State Long Beach, because again, I was at a community college and transferred. And I decided to move to a new brokerage called Compass. It is a more modern, technology-focused brokerage, whereas First Team is older. So I was really excited to make that switch, and I actually decided to partner with another agent. So just to backtrack a little bit, when you join a brokerage, you have a couple options. You can be a principal agent, fly solo and work as an individual, or you can join a team, and a team can be 2 of you in a partnership. It can be 20 of you. There's no rules or caps. So I decided to partner with this other agent, and it was just the 2 of us, and we worked together for about 1.5 years. And I really thought I was going to do so well that year. I had just had a few sales. I graduated. I had more time on my hands. I was still working for the builder, but I had Tuesdays and Thursdays when I used to be at school, and now I had free time to do real estate. So I had Tuesday, Thursday, Saturday, Sunday to work on my real estate business. And it was definitely the worst year of my career. It was not successful whatsoever. I put in so much time and effort and did not see any results. I was spending so much money marketing myself, hosting open houses every weekend, and really just getting nowhere. I think I had one deal that entire year, which was so hard mentally to work through. Just to put it into perspective, I got an opportunity in January or February. It was a listing. I got it on the market and it sat for 2 months. And then we finally got an offer, and that offer was a 90-day escrow, which meant we had to wait 90 days to close. And then I didn't get paid until June. So to find out I have this great opportunity in January and not get a paycheck till June is pretty tough when you're just getting started. So safe to say, worst year ever. I hate 2018. So after that year and a half, I decided I needed to change some things up, and I started interviewing around my office. I wanted to potentially join a team, and I found a small team of women. It was called the Annie Clordy team, and decided to join them. And the reason I went with them instead of other people, a few reasons, but Annie let me keep my part-time job, which was really important. Most of the other team leads that I interviewed with wanted me fully committed to real estate, and I was young. I needed to pay my rent, and I couldn't swing that at the time. I needed to keep that job. And so she allowed me to do that. She also allowed me to brand myself individually. I didn't have to put the team name on everything. And lastly, she gave me a good split. So this is a good time to explain. If you're on a team within a brokerage, when I get a paycheck, Compass, my brokerage, takes a portion, like I explained, and then your team lead will also take a split. So whatever money you think you're making, I get 2 hits, and then the remainder is what I get to take home. And then I have to pay taxes on that. So she gave me the most gracious split out of everyone. But if you're looking to get into the business, just expect that most people will ask, a team lead will ask for 50-50 on your first year. And then most of the other team leads will ask for like 70-30 after that. Annie offered me 80-20 at the time, and now I have 90-10. So it was a really good situation for me. I was able to take more money home. So that was a no-brainer. So fast forward to October 2020, I decided to quit my part-time job and transition to working in real estate full-time in the middle of the pandemic. Full transparency, that was not my decision. I was kind of pushed into it by my team lead. I'm very type A. I need to know what money I have coming in. I need to have a schedule. So the idea of transitioning just really scared me. But at the end of the day, I said, I've got a fabulous degree from Cal State Long Beach. I've got a ton of experience at this point. If it doesn't work, I'll just pivot. So I decided to go for it. And that is absolutely the best decision I've ever made. It's where my career fully took off. I think it's a combination of things. I had finally 4 years of experience. I was a little bit older, and I had been branding myself as an agent for 4 years. So people in my sphere of influence, my friends, family, acquaintances are starting to associate me with real estate. I was getting organic leads and calls from people I've met over the years. So it was really starting to come together. And so I'm currently now beginning my 7th year in real estate. When I went full time in 2021, I more than doubled my income. And then I did even better in 2022. So safe to say things are going well. And to fully expose myself here, I'm going to share my gross commissions from each year in the business. And I did explain, and I see I've got some questions in the chat, so we'll check those out in a second. I did show where I'm part-time and when I transition to full-time. So as you can see, my income definitely jumped once I committed to full-time. But what I do want to make super clear is this is not your take-home pay. This is pre-tax. So this really lovely number for year 6 of $240,000. I had to pay 30% taxes on all of my checks. So every time I get paid, I set aside my money for taxes in like a high yield savings account. And then you're also running a business. You are gonna see a lot of expenses, and that's gonna vary depending on what you decide to spend your money on. But if you're marketing yourself with print marketing or paid ads, all that adds up. When you have a listing, you pay for listing photography, videography, print marketing, signage, the MLS that all of our houses are listed in, that costs money. I think I spent a little over $1,000 a year. You have errors and omissions insurance for if you get sued, that's about $2,000 a year. So there's a lot of different expenses. So this is not my take home pay, but I just wanted to share an idea of what that gross number is. I'll take a look at the chat right now. The split, yes, that's with me taking the majority. So when my team lead is giving me, when I said she's giving me 90-10 right now, if I close a deal, Compass takes their split, and then Annie would take an extra 10% for her, and I'm getting the remainder. I would recommend taking all of your real estate courses before studying for the exam. The 3 courses that you'll take for the real estate exam, you'll pass each one of them. And then when you sign up for the exam, there's usually a waiting period. So that's when I would study. What was recommended to me was to take a crash course through a local brokerage. So I did a Saturday, Sunday crash course. I studied for 2 weeks, and then I repeated the crash course, and then I was able to pass. So really quickly, before I continue with some questions, I wanted to just explain a few pros and cons about.
Racquel,
Yeah.
but we'll make it easier on you. We'll read the questions and
Okay.
ask them to you, so you don't
Yeah,
have
you
to
don't have to read
sit
the
there.
chat. Yeah.
Okay. Sounds good.
Go ahead.
Perfect. So I'm sure someone here has seen Selling Sunset or Selling OC on Netflix, and it makes it look like our job is really easy and we get tons of money. And I just wanted to make it very clear that that is not the case. There are lots of benefits to this job. I would never stop doing real estate. I'm so happy with my career, but there are so many negatives too. And so I kind of want to just make it extra clear what your day-to-day will look like. But some of the great pros to this job is that you have flexibility with your schedule to an extent. If you're not helping clients and doing things with clients, you do have the opportunity to go get lunch with your mom on a Thursday or go on a trip. Like, you don't have to, you're your own boss. You don't have to ask anybody to take a vacation, or if you can go to the doctor in the middle of the day. So you do have flexibility and control with your schedule. And then the other pro is that you have the opportunity to make a crazy amount of money based on the effort that you're willing to put in. So I am just starting to find a good amount of success in this business. But my team lead, for example, I did 14 million in sales last year, and she did 70 million as just one person. She makes so much money. It's not even funny. And then there are people obviously that in our office that make double what she makes. So the opportunity is crazy. But the cons to this career are the lack of balance. Especially when I was younger, getting into it, I had to work 7 days a week, pretty much every hour of every day. I missed a lot of fun opportunities with friends. If they were going out on a Friday night and I had showings in the morning and an open house, I couldn't go with them, or I couldn't stay out late, and I missed all the fun things they were doing on Saturdays. I was writing offers Saturday nights. So lots and lots of social time sacrificed. Now that I'm later into my career, I definitely have more balance and don't have to do open houses every weekend because I have more organic business coming my way. But I still have a hard time setting boundaries. 2 examples I wanted to share. I had my best friend's wedding in a different state last year, and I flew there just for the weekend, just 2 days. And I'm on a team, so I have people to lean on. And I had everybody taken care of, got on the flight. And when I landed, I had so many texts from clients because new homes had hit the market. They wanted to see them right away. And so if they weren't on open house and they couldn't go on their own, I had to coordinate a teammate to go meet them and do the showing with them, which that part's easy. But once they've seen the house, now they want to talk to me, who they trust, their advisor, not my teammate, because they haven't bonded with them. They want to talk to me and they want to discuss an offer game plan. They want to do it right away. They're just so excited about the house. And so I'm in the middle of a wedding or a wedding ceremony with my phone going off. And yes, I can set boundaries. I can turn it off and not respond to them. But buying a home is a huge transaction. Most of my clients are first-time home buyers. The last thing I want to do is make them feel not supported. So I let them know I'm at a wedding and I'm going to have to do it in the morning. But you know, you drink at a wedding and you have a good time. And then in the next morning, you want to relax. And I had to wake up at the crack of dawn and try to get these offers out. So you're kind of always on. You can't really unplug. And there have been many tears where I'm just exhausted, wishing I could go on a vacation like a normal person. And then the other example I wanted to share, which was just this past Super Bowl weekend. It was a Friday night. I was cooking dinner, poured my glass of wine, thought, you know, I had no more work to do for the day. And I had a brand new high-end client text me at 7 p.m. Why they thought 7 p.m. was a good time to reach out, who knows? But that's when they wanted to text me. I responded pretty quickly and asked if we could do a call in the morning. And they said they'd prefer that night. So we spoke from 8:30 to 9:30 on the phone. No more wine. Couldn't cook my dinner. And they wanted to see houses the next morning. So that meant I had to rearrange my Saturday schedule. I had to wake up early, get all those showings booked. I was with them all day long. And then I had dinner with my parents, thought I would unplug then. And they were texting me comps the whole night. So you can't plan your schedule. You have to be really flexible, which is, I just never thought I would do a job like this because that's not how I operate. But you do get used to it. You figure out how to balance it all. You figure out when it's appropriate to set boundaries, but it is mentally very, very tough because you're always on, like 10 p.m. text messages all the time.
The
So-
question came in sort of
Yeah.
fits with what you're talking. What does the team do for you?
Okay.
Why is the team important?
Okay, so this will vary depending on the team that you join. So you'll want to ask a lot of questions as you interview, but personally, from my experience, my team, we all operate individually. We have our own businesses, but the team comes together to collaborate. We have team meetings. We're holding each other accountable, talking about our businesses, setting goals. It's just a great way to keep yourself. This business can be really lonely. It's a great way to collaborate with other people, keep yourself motivated. And not to mention, you have a team lead in place who my team lead has been in the business over 20 years. So I can pick up the phone and call her at any given moment and ask her a question. And you are always going to have a question. I don't care how long you've been in the business. You're going to learn something new on every transaction. The contracts are super dense. You're never going to know it all. And so it's just nice to be able to call someone and lean on them and ask them questions and make sure that you're representing your clients properly. Other than that, my team lead will do like team branding videos, put us in magazines. She'll pay for stuff like that. Other teams, it's a different story. You can't call them. You can't get them on the phone. They take a much bigger split. They don't let you hold other agents' open houses. So some teams put lots of limitations on you, but most teams don't. So try to find one that's a good fit for you and good people and are willing to help you as you grow. The one thing I will say, some teams do give leads. So if that's important to you, you'll want to find a really, really big producer that pays for a service like Zillow Leads. And as they get these internet leads, they'll share them with their teammates. they're not always quality leads. We tried to do it one time and we didn't really love the clientele that we got from it. But yeah, some teams will give you leads as well. I hope that answered that.
And I've had a question. Do you also do vacant land?
I have not personally sold any vacant land. I have had clients ask about listings, but I haven't done a deal on one. I think I know that I'm licensed to, but I would probably speak with someone who has experience to make sure I'm not missing anything. A great example of one of our managing brokers told a story once. One of the agents sold it was a place in the wine country. It had vineyards on it. And the agent was like, yeah, I'm going to take this deal. I sell houses all the time. Who cares if there's vineyards on it? But apparently you needed to, or vineyards or crops or something like that. And apparently she didn't know because she wasn't experienced in selling the properties in that area. But you need to put some verbiage in the contract saying that they won't take the produce when they leave the house. So the seller, when they were leaving, they took all the avocados and all whatever the produce or crops were, they took it all with them when they left. And that was a huge deal to the buyer. They did not think that they would take that. So it's important to either refer it out to someone who knows better or to ask questions from someone experienced. So no, I've never done a deal on vacant land, but I'm absolutely licensed to. I would just want to make sure I'm protecting my client and including all the verbiage I need to in the contract.
Would you ever be interested in having your own brokerage firm?
Yes and no. I think my next step would be to create my own team. I think down the line, that's something every agent thinks about, is opening up their own brokerage, but there's a lot of costs and liability and expenses. So that's why a lot of people will just join a brokerage instead of creating one. I think I would rather create a team instead of a brokerage.
Okay, and then question is, do agencies pay upfront for expenses such as marketing and then just deduct on payouts, or are you on your own for this?
You're on your own.
You basically have your own business, right?
Yes. Yes. So that's what's tricky about being an agent, is that you're thrown into this and you need to be your own marketing rep, your CEO. You have to do all the paperwork. You're out in the field doing the sales. So you have to wear many hats. I'm out at showings, talking with clients. I have to come back. I have to do all the contracts. I have to be posting on social media and creating cool content to keep me relevant. It's a lot of different things that you have to do. But no, the brokerage does not pay for any of your marketing. If you're on a team, your team lead might be willing to do that. It depends on the setup that you have in the contract you sign. My team lead does not pay for my marketing unless it's her idea, unless it's a team article in a magazine. But if I have a listing and I want to promote it, that's on my dime. Everything for my business is on my dime.
She has more stuff.
Okay, that's it for now.
Okay. So that is a perfect transition to buying a home. So if there's any other questions about getting your license or being in the industry, we can either answer those now or save them till the end, but I'll quickly go through what it looks like to buy a home in case any of you are interested. So like I said before, not only am I a real estate agent, but I bought my first home 2 years ago. When I was a student at Cal State Long Beach, I never in a million years thought I would buy something at 26, but I think it's more achievable than you might realize. And sometimes you just have to start with talking to a lender and figuring out what you can afford. I just hosted a first-time homebuyers event locally in Newport Beach, and I had a bunch of potential first-time homebuyers come in a room and learn a presentation similar to this. And a few of them aren't even thinking of buying for 5 years, but they just kind of wanted to get an idea of what the process looks like so they feel a little bit more prepared and educated and make it a little less scary. So the first step is to build your team. So you're going to find a real estate agent and a lender that are knowledgeable and experienced. Make sure you interview a few and you really like the personality of the people you're working with, because you're going to spend a lot of time with them. And then the number one thing that I would say is, are they responsive and are they communicative? Because, for example, if I was your agent, we're going to go see a house on a Friday at 3. We might want to write an offer that night. Maybe they have 2 other offers already. They want to review immediately. We're going to want to write up an offer right away. And if I can't get a hold of your lender because he signed off on Friday at 5 and he's not coming back to work till Monday at 8, that's going to be a huge issue, because we want to present your offer with your pre-approval letter. We want to be able to ask the lender questions about what the monthly payment would look like. So you just want to make sure you've got pretty much hustlers on your side to make sure that you're supported at any given time, within reason. And then once you build your team, you find your agent and your lender, you're going to get pre-approved. And this is important to be your first step, because we need to determine what you can afford. We don't want to go out and look at houses first, because we don't want you to fall in love with something that's out of budget. So you're going to get pre-approved with the lender. You're going to submit W-2s, 1099s if you have them, bank statements, and answer a few questions for them. And then they're going to be looking at 3 things to qualify you: cash, capacity, and credit. So your credit score is important. Capacity is your debt to income ratio. And then your cash is how much money you have on reserves for like down payment and whatnot. So those 3 things will determine your monthly payment. And that's actually how we qualify you, as a monthly payment amount, not a purchase price amount. And so what you can get pre-approved for might not be what you're comfortable with. So we'll talk through all that. If you get pre-approved for $6,000, but you can't imagine paying a penny over 3, then we're going to look at what $3,000 a month can get you and kind of go from there. So once all the boring numbers are done, you'll get to start your home search with your agent, hopefully me, and we will kind of dive into the fun stuff. So what we will start with is going through your criteria. We will talk about a list of what your must-haves would be in your future home. So for me, when I was looking in Long Beach, and I wanted a condo that had ample parking. I needed 2 parking spots and I needed 2 full bathrooms. So those were non-negotiables for me. So you'll make a list of non-negotiables, and then we'll talk about cities that you would want to focus on. And a lot of my clients know exactly where they want to look, and a few don't really know. So I can help you there, look at what your budget is and your must-haves, and tell you what areas would be smart to look at and where you can get the most bang for your buck. And then once we have that criteria, I'm going to plug it into a saved search. I am with Compass. So we have a platform called Compass Collections, where I plug in your saved search and all of your listings come through, and it kind of looks like a Pinterest board. So we'll both be on this Pinterest board. All your listings will present there, and you can delete and favorite. You can comment directly on listings and ask me questions. So it's a really great way to collaborate and keep it organized. Essentially the same thing that you do on Redfin or Zillow, just a different platform where we can collaborate, and you'll get notified every time there's a new listing. So once you eventually fall in love with a house, we're going to want to go schedule a showing. So I can do a private showing for you, or we can attend a public open house on the weekends. Don't worry, showings are not like an 8 to 5 thing. I had clients who worked pretty much 7 days a week, and they could only do showings at like 7 p.m. on a Thursday night. So as long as the seller agrees, I'm happy to do showings at that time. I will accommodate your schedule. And then if you ultimately fall in love with the house and want to write an offer, we'll quickly check with your lender and make sure you're comfortable with the potential monthly payment based on the current rates. So once you want to write an offer on a home, this is where things can get a little bit more overwhelming. You are being introduced to a contract you've never seen before. I'm going to be throwing terms at you that you've never heard before. So I wanted to quickly break down the components of an offer and simplify it the best I can. So I split it into these 6 components: price, earnest money deposit, inspection, appraisal, and loan contingency, and close of escrow or escrow length. So just quickly going through these, when we are writing your offer, we're going to talk about price. So if you find a condo that's $600,000, if it's been sitting on the market, we can offer under asking, we can offer at list price, or we can offer over asking if there's a ton of competition. So we'll determine what you want to offer. And then earnest money deposit is the next piece. And that is also called a good faith deposit. So if we are lucky enough to get your offer accepted, we are going to open escrow with the seller. So escrow is basically the period of time between when you get your offer accepted and when you get your keys. And we're going to be going through, you're basically investigating the house and making sure it's something you want to purchase before committing and closing escrow. And you've got a neutral third party called an escrow company running the transaction. And they're like the middleman between the buyer and the seller, protecting both sides. So if we open escrow within the first 3 days, you are required to wire an earnest money deposit to that escrow company. It's basically the buyer telling the seller, hey, I'm serious, here's a deposit while I investigate the house. And normally the standard is 3% of your purchase price, but we can make it less or more. So we'll talk about what we want to offer for deposit. And then after that is where it gets a little bit confusing. We've got your contingencies, your inspection, appraisal, and loan. So contingencies are like a window of time during escrow where we are investigating the home and making sure that it's still something you want to move forward with. So within a contingency period, you're doing your due diligence, you're looking into everything. And if you're not happy with your findings, you're allowed to cancel and leave the transaction because you're within that contingency window. If we remove those contingencies, you're locked into the deal. So quickly going through each one of those, your inspection contingency, and each of these contingencies standard are 17 days. So when we're building your offer, we'll talk about, do we want to give ourselves the full 17? Do we want to shorten the amount of time to be more competitive? So for that inspection contingency, this is where you bring in a home inspector and you go through the house and make sure everything is working properly. They'll look at the roof, the water heater, the appliances, and they'll let you know if anything is concerning. They'll give you about a 40 to 50 page report. And that is one of your only expenses out of pocket during the transaction. In addition to that home inspection, you're going to be reviewing seller disclosures where they tell you everything they know about the home. If there's a homeowners association, you're going to get to review those documents, review your title report. So there's a lot to review during that inspection contingency. And if you find anything that you don't like, you're allowed to exit the deal. Moving on to the appraisal contingency. If you are getting a loan, your lender is going to send out an appraiser to appraise the home and make sure that it's worth the amount that we are offering. So our purchase price. If it's not appraising and it comes in under value, you're allowed to cancel the deal if we can't negotiate with the seller. Your loan contingency is where the lender is working through your file and working towards loan approval. So not much to do for your agent and your lender's just kind of working through the file. So once you get through those 3 contingencies, you can remove them and lock yourself into the deal. And that's when you are at risk for losing that earnest money deposit. And then the last piece to the puzzle is that close of escrow or escrow length. So again, that's from the day you get your offer accepted to the day you get keys. And standard is about 30 to 45 days, but in a competitive market, we will offer 15 to 20 days. It really just depends on the seller situation and your situation. Sorry, that was a lot of information. So quickly just showing you here what this escrow process looks like. If we are lucky enough to get that offer accepted, the seller will either accept your offer as is, which is a dream scenario, or they'll counter offer and try to negotiate some of the terms, or third, they'll just reject you. So we're going to pretend they accepted our offer as is. And now we're going through the escrow process. So in the beginning, you might meet with a lender, depending on who you're using. They might do a contract meeting where you review the current interest rates, taxes, and numbers. You're going to get a whole slew of disclosures from both the real estate agent and the lender. Then you're going to do that inspection we discussed and bring an inspector into the home. And if you find anything that you're not happy with, for example, the roof is falling apart, instead of just canceling, you can ask the seller to repair or give you a credit. And the seller is not required to do anything, but it's in their best interest to work with you and keep the deal together. So you could ask for 20,000 and they might give you 10,000. That's just a piece where we can negotiate anything that comes up as an issue. And then next is your appraiser, your appraisal. So the lender sends out the appraiser, like I mentioned, then a loan approval and clear to close. The lender's working through the file. And then the last three pieces are your final walkthrough, which is where we go back to the house and make sure it looks exactly the same as when we wrote your offer. It's in the same condition. And then again, if you ask the seller to do any repairs and they agreed, we just want to confirm that those were done. And then you're going to sign all your important docs with a notary fund. You're going to send in all your final funds to the escrow company, which is like the balance of your down payment. And then the lender sends their money. And then finally, we will be closed. So closing day is super exciting. The escrow rep, title rep, and lender, everyone's going to work together to get your file recorded at the county. And when that happens, I'll get a call from the escrow rep saying it's officially been recorded. I will call you and say, hey, homeowner, congratulations. It's official. The house is yours. And we will schedule a time to meet for keys. So I'll meet you at the property, give you the keys, place is yours. So that was a very quick, very detailed overview of what the process would look like. But I just wanted to do that quickly so you guys had a rough idea of what it's like when you go through the process. So that concludes kind of what I wanted to go over today. But if anybody, I'm going to go through the questions obviously right now, but after today, if anybody wants to reach out to me about getting into real estate, getting their career started, or if you need help with renting or buying, all of the above, any real estate questions, please don't hesitate to reach out to me. I included my email and my phone number, and then also my Instagram at Sell with Racquel. So thank you guys for having me today.
So we can ask the questions, Racquel, so you don't have to send through the chat.
Okay, well, a couple of them sort of tie together. One is now a good time to become an agent, a new agent, and how have interest rates affected your business?
Okay, so is now a good time to become an agent? I think anytime is a good time to become an agent. Don't let the market ever deter you. If it makes sense for you to dive in, just do it. Get your license, put in the effort that you need to, and I think you'll find success. As long as, I mean, so many people get their licenses and do nothing with it, and they barely try and then they quit. So just put in the effort, and I'm sure you'll find success. It's tough work, but it's so worth it. Sorry, what was the other question? The second question? Oh, how have the rates affected my business? Is that what it was?
Yes, somehow
Okay.
I turned myself off.
Oh, good. So I expected to have quite a bit of a slowdown. Personally, a lot of agents around me really struggled with the rate change and did not have a lot of sales for whatever reason. It didn't slow my business down. I actually had quite a few clients reach out to me right when the rates jumped up because they personally felt that the market was cooling a little bit. They saw a lot more price reductions. They saw homes sitting on the market longer, and they felt more comfortable entering the market at that time. So I personally did not feel a slowdown, and I had a lot of people reaching out. But what I will say is I had a lot of buyers I had a buyer just recently I worked with for a year and a half. They were looking when the rates were really low. And we were fighting 40 offers per property. They were having to go 300,000 over asking, and they just weren't comfortable with that. So we kept missing out. And now, a year later, they're looking at homes and their interest rate has doubled. So they can afford less home, but there was less competition. And so they had more time to think. And so they were happy that they waited, even though the interest rates were doubled. So it really just depends on the client and the situation.
Yeah, I'd say that's true. You don't want to get into something you're going to live in with a bad feeling.
Right.
Right. So here's actually a very good question. How much does it cost to buy a home? And then we're not talking, not if it costs $1 million to buy a home, but what cost above and beyond the home are there?
Yeah. So when you're talking to a lender and getting pre-approved, they're going to ask you what you want to do for a down payment. And so personally, when I was looking to buy, I decided that I could afford to put 5% down. So the rule that you hear of having to put 20% down is not true. You can put 5% down, 10% down. If you do an FHA loan, you could do 3.5% down. So you'll talk to a lender about what your options are, but basically that percent down is whatever the purchase price is. So just a real life example, my condo cost $592,000 in Long Beach. I put 10% down. So that was $59,200 for my down payment. That is not the only money that I had to bring to the table. There's also something called closing costs. Those are like your lender fees, your escrow fees, your appraisal costs money. That's usually like $600 to $800. Title fees. There's a bunch of different fees. I want to say my closing costs were about $10,000. So I was looking at around 65 to 70,000, I think, at the end of the day for what I had to put down. Keep in mind when you're negotiating like repairs with the seller, we can get credits, and those are going to go towards your closing costs. So if there's a huge issue with the roof, like I said, and we can get a $10,000 credit, that gets applied to those closing costs, and then you owe $10,000 less on closing day. Another thing I want to mention is in this market with the high rates, a lot of the agents are asking for seller buy down. So if there's not a ton of competition, I can write your offer for you, and I can ask the seller to give you a credit of however much. So like the last one I did was 10,000 towards buying down your interest rate. So you can use that credit of 10,000 from the seller to buy down your rate and get a lower rate at the end of the day. So that's a strategy we're using right now.
Well, the $1 million question for all the students, as well as for you 5 years ago, 6 years ago, is how in this market anybody can ever buy something.
I know. And it's the number one question I get all the time whenever anybody brings up real estate. I think the best way to think about it is I have a lot of clients that want to buy, and they want it, if they're going to invest a ton of money and they're going to make this big purchase, they want it to be their dream home. And I think that's where it becomes an issue, because if you're trying to save up money to get into your dream home, while you're waiting to save, prices are going up, rates are going up, and you're getting further and further away from being able to make that purchase. So my biggest advice would be to purchase a starter home. So that's kind of what I did. I'm in a condo under 600,000 in Long Beach. I had to sacrifice some things. I don't have a ton of space. I think I have 1,000 square feet. And I love my place. I definitely like it. That's why I bought it, but I didn't buy my dream home. But the goal is to hold on to this for a few years, and then I can hopefully build some equity, use that equity to get into an even better home. So use real estate as a stepping stone. Don't wait to buy a dream home. Just buy something that's more affordable, and that obviously, yeah, make sure it's affordable, make sure you're comfortable with the monthly payment, but buy something within reach. Live there for a few years and then just keep using it to get to the next house is my best advice.
Well, that's great. And a question, how do you help a buyer that has to compete with all cash buyers?
I would say my strengths as an agent are how I connect with the other agent on the other end. So as you might have heard, the market was really crazy in 2021. I was working with a ton of first-time home buyers, and we were up against 40 other offers. And I've only been in the business for 6 years, but that's normally not the case. I used to compete with 1 or 2 offers. I had never even competed with over 10, and now we're competing with 40. And obviously some of them were cash, but you have to have a beautifully written offer, super, super clean. You have to have really competitive terms and be creative with your strategies. And then you have to have an agent that communicates well. So as soon as we see the house, I'm calling the agent, I'm building a relationship with them, building a rapport. I'm asking, what does the seller need or want in this offer? How can we stand out? Once we submit our offer, I really do everything I can to get us a counter. And then once we get a counter, I try to call the agent before we respond at the last second and try to figure out, where other things are landing so that we can be in the best position. Another thing I've used is an escalation clause. I used it a lot in 2021, which is where you say buyer to pay $5,000 higher than than any other buyer's highest offer. So you're ensuring you're that top offer. That was a way that we stood out during all the chaos, but I've beat out a lot of cash offers in the past. They're typically not the highest. The only reason cash is better than yours is there's no risk of a loan falling through. So as long as I can communicate to the agent on the other side that you're a solid buyer, your loan is solid, I've worked with this lender for years, there's not going to be any issues. As long as we can communicate that, you'll have a really good chance. You can also get your loan fully underwritten, which means you go through a majority of the underwriting process before we even get into escrow, which means there's less risk. So again, I would say at the end of the day, have a good agent supporting you and using really good strategies to make you win.
And the last question, since we've used our hour, the question here is, do buyers have to pay you upfront to hire you as a realtor, and do they have to continue to pay you until closing?
So buyers don't have any cost to use an agent. The seller pays the commission. So I'm technically not allowed to say that the service is free to you. That's a new rule, so I'll avoid saying that. But a buyer will hire me. There is no payment to me. I represent them through the whole process, whether it's a month or a year and a half, and I don't get paid until closing day. And the payment comes directly from the seller's proceeds. So when a seller goes to list their home, they sign a listing agreement with their agent, and they determine the commission amount right then and there. There's no standard, but what I usually see in Orange County and Long Beach is 2 to 2.5% on each side. So they'll write that in their contract, and when they launch their listing, that commission amount is in the listing. So I can see what I'll get paid at the end of the transaction ahead of time. So they'll pay their agent and me. So the buyer has no costs other than buying the house, which is nice. You don't pay till you have to sell.
About 60 potential new buyers here for the next few years.
That would be exciting. And I do help with rentals. So if anybody needs help with that, like most agents will avoid it because it's a ton of work. But my whole family still rents. None of them own. And I rented up until I purchased now. And renting can be really stressful. So I like to help with that process too.
Well, that's great. We really appreciate you coming on today and sharing your journey to real
Thanks.
estate. And I'm very pleased to see that you're doing so well. You know, we've talked about this. Racquel was worried about adding me onto her monthly newsletter.
Yes, I felt a little silly. So as an agent, one of the number one things they tell you to do is send out an email blast once a month, and they say add everyone you can think of. And so I added you, and I was really nervous that I was going to be, you know, bothering you. So it was such an exciting moment when you emailed me and asked me to speak. And I also had mentioned to you on the phone that it was tough because I was in real estate when I was at Cal State Long Beach, and I swear I exited your class a couple times mid-lecture to take a client call. So I'm so sorry.
It was your job.
Yeah. Well, any more questions?
I don't have any here, so.
Okay. Well, if anybody wants to reach out separately or individually, feel free to email me, text me, or send me an Instagram message. I'm happy to help you get started in real estate. I get coffee with people all the time. I like to be as much help as I can. Or if you have questions about rentals or sales, happy to help you there. It looks like somebody said, how do you make money off rentals? I'll quickly answer that. Rentals, it's the same. The landlord pays both agents. The commission should be, usually we hope that it's 3% of the first year's rent, but many will do a flat fee because they don't want to spend a lot of money to sell the place. They'd rather just put it on Zillow for free. So unfortunately, like the last one I did, I helped a client for 2 years look for a rental, and the flat fee was $100. So 2 years of work and I got $100, but my clients were really grateful, and you know, you never know what'll come of it. But my Compass took their split. So I think I got like $88. But it depends. I could make usually like the most I make is about $1,200 to $2,000 if it's a high-end lease.
One last question, Racquel. Do you think it's a buyer's market or a seller's market with interest rates going up?
That it feels tricky to answer that, and it depends on the market we're looking in. I feel it's kind of in the middle. So I have a lot of clients looking in areas where there's not any inventory. So the second a home pops up, we're still seeing 10+ offers. So in those situations, it definitely feels like it's a seller's market. And then in other areas, I just got a deal where it sat on the market for 100+ days, and we got a great deal. So I really think we're kind of at this neutral point. It really depends on what the price point is in the city and the area.
Thank you.
Of course.
Okay, well, maybe you'll get this evening off now.
Maybe.
Thank you again so much, Racquel, for
Thank you
joining
so
us
much.
today. Yeah, I'm sure some of our students will reach out to you.
Yeah, that would be awesome. Thank you again so much for asking me to do this. It was the best moment ever, and I'm very excited.
Thank you.
Great, thank you.
Have a great Friday.
Bye.
All right. Well, thank you everybody for joining us today. The recording of the talks and the slides will be up on our website, Beachfront Rising website, where you initially went to register. And we will be back again in the fall with new topics, and I would like Dean Sol to say a few words to close out.
Another wonderful symposium. Thank you for organizing this, Frank and Pia. I learned a lot myself for the sessions I've sat in on. And again, I really appreciate all the questions from our students. And now I'm looking forward to the next symposium. So thank you very much, everyone. Have a great weekend.
Have a great weekend and go beach.
Go Beach.